The economy is probably not as interest rate sensitive as it was in previous cycles.
Some of these most interest rate sensitive sectors of the economy, you are seeing a bite.
We are seeing interest rates bite different parts of the economy at varying speeds.
In a world of higher long-term interest rates, equity returns are likely to moderate.
The housing market is really kind of the first domino to fall on what we think is going to be a slower growth story down the road.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get you to the weekend. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance, where equity futures are negative by 0.2% on the S&P 500 as we head towards a week of losses on the benchmark and the equity market stateside, just before we get another read on US inflation at 8:30 Eastern Time. Plenty of coverage on that in just a moment. We begin, though, with our top story. The President of the United States, Anne-Marie, found guilty.
Found guilty on 34 counts. This has to do with the hush money trial that has been taking place in downtown Manhattan. This has to do with falsifying business records. Coming out of this, though, the former president greeted cameras. He called it a disgrace and something him and the current president, Joe Biden, agree upon. That was the rhetoric following this conviction yesterday, that it is going to be up to the American people to decide who should be in the White House.
Well, check out the calendar for the next month or so. This is what it looks like, and it's quite a calendar. June 27th, debate between Trump and Biden. Rhame, July 11th, Trump sentencing. 4 days later, RNC.
Which is really kind of the key question to me is how much do the Republicans continue to consolidate around Trump? Right now, he really has had the gravitational force. So far, the rhetoric from all of the Republican Congress members has been incredibly supportive. Can you imagine, though, what it looks like if, say, he's sentenced to jail right before the convention in Milwaukee, Wisconsin? A lot of questions, a lot of polls suggesting that this won't change anything. It just feels uncertain how much to weigh it from a market perspective, which is the reason why it's not doing much at all.
Well, we can talk about the money. The fundraising started almost immediately. The former president's campaign, they've raided my home, arrested me, took my mugshot, and now they've convicted me. Before the day is over, I'm calling on 10 million pro-Trump patriots to chip in. Well, some billionaires are about to chip in. Miriam Adelson, Steve Schwarzman, Harold Hamm reports that Bill Ackman will do the same thing.
Absolutely. What you saw last night actually is Trump's campaign website falter because too many people were trying to log on. On Friday, what we saw from Schwartzman is that he said he's going to vote for Chain. Miriam Alderson, our reporting, is that she's prepared to come in with some cash. Bill Ackman is prepared to endorse him. Also yesterday, Sean McGuire, partner at Sequoia Capital, he's backed several of Musk's company, said that he's putting more than $300,000 towards the Trump world to make sure that Trump becomes president. Some of this has unnerved big donors, and they're going to stand behind him.
I guess one larger question that I have is we have the likes of David Sachs coming out, who does support Donald Trump, talking about how there's only one question now, whether the U.S. will be a banana republic. On the other hand, it's law and order, and this question of if there are 12 jurors that were selected by both sides who did convict him, there is a question about what this does to the sort of establishment of institutions, more broadly. Is there going to be attack on both sides in a way? At a time when a lot of people are kind of casting doubt on the importance of why this case was brought. Not necessarily the legitimacy of this case, but why it was tried at a time when a lot of people are saying, okay.
What changed for the electorate yesterday afternoon? We need to talk about that. What actually changed? And the incoming polls will be closely watched for this. But going into this, the poll that you cited from NPR PBS, right before this verdict, 2 in 3 registered US voters say a guilty verdict would have no effect on whom they plan to vote for in the presidential election come November.
What's so interesting about that poll is that 74% of those were independents. That's the key margin for both of these individuals to win. Trump is going to bring his base. Biden is going to bring his base. 7 swing states, it's the people in the middle that matter. But going into this verdict, polls were mixed. We also had a May 23rd poll from Marquette Law School. And this is what they had to say. A guilty verdict would produce a 4-point lead in a national head-to-head match for for Trump, with a not guilty verdict would have resulted in a 6-point Trump lead. What it says is it's mixed. So it matters now, the messaging going into November.
We've got a lot to talk about this morning before we get to June, never mind November. Equity futures on the S&P 500 negative here by 0.2%. Here are the scores in the bond market. Yields just a little bit higher by a basis point, 455.60. Yesterday, BMO's Ian Lingen, it was a bond-friendly round of economic data. We'll see if we get the same thing again at 8:30 Eastern Time. Yesterday was kind of fascinating. We had the former New York Fed President Bill Dudley in a Bloomberg opinion column say maybe we're not restrictive enough. And then the present New York Fed president come out and say that we are restrictive enough. I think we could all see what was happening there yesterday afternoon.
Basically, New York Fed President John Williams came out and said, all right, Bill, no way. These are the exact words. I expect inflation to resume moderating in the second half of this year. He remains on track. Lori Logan, however, I thought was really interesting. She kind of supported a little bit of what Bill Dudley said. Dallas Fed President coming out and saying basically policy may not be as restrictive as we think it is, and all policy responses are on the table. Again, yes, we pay attention to the big three. It still is interesting how much differential there is.
You want some good news? Here's the good news for you. This is it. Quiet period after today. No more Fed speak through next week. Going into the decision the week after that. Coming up this hour, here's the lineup for you. Terry Haines of Pangaea Policy as former President Donald Trump prepares to campaign as a convicted felon. Peter Tchir of Academy Securities as investors await the Fed's top inflation gauge. And Ellen Wald of the Atlantic Council as OPEC debates production cuts into 2025. We begin with our big story. Former President Donald Trump found guilty.
This was a disgrace. This was a rigged trial by a conflicted judge who was corrupt. It's a rigged trial, a disgrace. They wouldn't give us a venue change. We were at 5% or 6% in this district, in this area. This was a rigged, disgraceful trial. But the real verdict is going to be November 5th by the people.
Former President Donald Trump set to campaign for his re-election as a convicted felon. A jury of 12 New Yorkers finding Trump guilty of falsifying business records to hide a hush money payment to an adult film star. President Joe Biden's campaign saying this: there is only one way to keep Donald Trump out of the Oval Office, at the ballot box. Terry Haines of Pangaea Policy joins us now for more. Terry, your reaction, sir, to yesterday afternoon?
Well, as far as the election goes, where I keep my focus for markets, I think it's a small, immediate net negative for his chances. What Trump needs to be doing is unifying Republicans and getting a majority of independents on his side. That was the winning formula in 2016. He didn't make that in 2020. Right now, it looks like he's not making it in 2024, with Nikki Haley voters showing 20 to 40% in primaries, depending, right? Even after Haley got out of the race, she still got 15% in Pennsylvania, which will show you a lot. But I don't think it's a seismic negative for Trump's candidacy or a huge bump for Biden. And as you all point out, just in the visual there a minute ago, there's going to be a lot of other bumps just in the next month or two here, including the debate, the sentencing, and the Republican convention. So this thing's going to go back and forth for quite a while.
Terry, what does the mixed polling that we saw ahead of this verdict mean to you? Is this just an electorate that's very fickle on whether or not this case matters?
Yeah, I think so. What you got is a couple of things. One is you've got a lot of people, there are polls about this too. There's a ton of people, as you well know, who haven't been paying much attention to the case at all. So what we're likely to see here, I think, this is instinct at the moment, is that you're likely to see that as the convicted felon thing gets hammered in, a measurable but small drip, drip, drip kind of away from Trump as things go. But also understand that most of the polls, the vast majority of the polls this month particularly, have been registered voters, not likely voters. So, and that matters a great deal. You had a 66.6% turnout in 2020. That means a lot of things, including that if you're looking just at registered voters, you're looking at a huge polling skew all by itself.
Terry, last night I read your note after this conviction. You reminded your audience that, quote, the conviction makes it harder for Trump to attract serious financial and political backing for Wall Street. I haven't seen any evidence of that. To the contrary, Bill Ackman is said to be getting involved, Schwartzman, Adelson. Who do you think this is going to actually impact on Wall Street?
Well, I think it impacts a lot of people because think about the people that you cite are people that are either private or have the ability to essentially say, well, I'm going to do what I want personally and not get any blowback. But on the other hand, if you're looking for the average Fortune 500 CEO or C-suite person who has to answer to shareholders, they're going to be awfully circumspect about about how they put themselves out there, or if they put themselves out there at all. I mean, they don't want to risk public blowback from supporting Trump, I think.
Terry, people are exhausted. I feel like you said a lot of voters aren't following the trials. At the same time, the sort of drumbeat, the drip, drip, drip has sort of steadily undermined people's faith in federal institutions. We've seen this in poll after poll. There was a study recently showing that maybe that is part of what is behind people's sort of negative sentiment, even in the face of better data, at least economically on paper. How much do you think this is going to affect turnout, if nothing else, at a time where there are a lot of double haters?
Honestly, I think it's too soon to say. You had in 2020, you had about a 6% turnout bump up. So, and I think that was, in large part responsible for Biden squeaking through there. But there are a lot of double haters, but at the same time, as Peggy Noonan pointed out in the Wall Street Journal today, we're a country that's starting to like to hate. She's not touting this, of course, starting to like to hate in part because it's energizing. So, what political parties count on here, and what the candidates are counting on, is that, that sort of energizing actually leads to greater turnout. So, I think there's going to be a lot of energy around this race still.
Do you think that then the July 11th sentencing is actually going to galvanize the July 15th RNC convention in Milwaukee?
You know what? I think the sentencing is, it largely depends on what that sentence is, whether it involves jail time or whether it involves something much less. But either way, the convention in Milwaukee, I think, is going to be put forward at a very high pitch. And my sense of that is that may help the base, which I don't think the standard Trump base really hasn't grown since 2020, and I could cite you a lot of things to show that. But I think that turns off a lot of the independents that are that Trump needs in order to win the general. I think that might be a problem for him.
Terry, you're sticking with Biden, and you've been sticking with Biden for the last several months. Terry, what's the road to November for Joe Biden?
The road to Joe Biden for November to Joe Biden is to continue to show that he's up to the job. Really specifically, Biden's cognitive issues are always front and center with people. I want to point out that Trump's cognitive issues are recognized by voters as well. Voters think that that Trump's got some issues too. But what tears it, I think, is simply that Biden's the incumbent president, and Biden needs to show that he's up to it, and that's the threshold question in the election. Because if he's not, for some reason, things change dramatically, and I think in pretty unpredictable ways.
Hey, Terry, it's good to hear from you, sir. Thank you. Terry Haines there of Pangaea Policy. Plenty of coverage on this story throughout this morning. Libby, Cantrill of PIMCO joining us in the next hour, 7 a.m. Eastern time. Do not miss that conversation. Let's get back to the calendar just briefly. The end of June, next month, that debate between Trump and Biden, must-watch TV in a much bigger way after yesterday's events.
Absolutely, especially as you see both campaigns saying that this is now going to be about the voters. The voters are going to be the ones to deliver the final verdict. And this is going to be really the first time, potentially, Biden is going to have to address this so head on. He's obviously going to be asked about this from reporters. Air Force One, a number of events he's going to have. He's going to be asked about this. But this is going to be a moment where he's going to face Trump and really have to say what he means about Trump being the first former president in American history to be convicted of crimes.
I'm looking forward to what they say about their tariff policies in that debate, as well as what their policies are going to be on immigration.
You're hopeful.
That's why Lisa's tuning in.
Bramo's hopeful. I think we're all hoping we get something like that. Let's see if we will. Let's see if we will. If you are just joining us, welcome to the programme. Equity futures here down about 0.25% on the S&P. Some big moves on some single names in the last 24 hours. We'll be talking about that in just a moment. Let's get to the Bloomberg brief. brief with some news elsewhere this morning. Here's Danny Berger. Hey, Danny.
Hey, John. President Biden will allow Ukraine to launch U.S.-provided munitions against military targets inside a limited area of Russia. The president gave permission for strikes near the northeast border area of Kharkiv so Ukraine can help neutralize a Russian advance in the area. And here's one of those companies, John. Dell getting punished in the pre-market trade, down 14.38%, despite the fact that it reported its first revenue increase since 2022. But it wasn't enough. Investors had high expectations for the AI server business. And on that, in the post-earnings call, the CFO of Dell was questioned by a Bernstein analyst who posited that AI server margins were effectively zero. The CFO said she does expect demand to continue for the AI server business. Dell stock had more than tripled over the past 12 months heading into the report. Gap shares, though, they are surging in the pre-market trade, up 24%. It reported first quarter results that topped Wall Street estimates and raised its outlook for the full year. All of Gap's brands posted comparable sales gains and outperformed expectation. The company added Zach Posen as its creative director in February and has turned to celebrities to boost its visibility, with Anne Hathaway and Divine Joy Randolph sporting Gap dresses at the Met Gala and other recent fashion events. And that's your Bloomberg Brief, John.
Danny, thank you. If the 90s are back, Abercrombie's back, shouldn't Gap be back?
Oh, it's trying.
Right.
I mean, but do they go back to the staples, or do they still try to be,
I think it's the staples for Anne Hathaway. She recently wore this very cool-looking shirt dress, and I looked it up. It's from the Gap.
And you bought one?
I didn't buy it. I might go check it
Came
out.
close to buying. Okay, that's where we are. Up next on the program, looking for signs of a slowdown.
We're looking for the possibility of 1 to 2 cuts at the end of the year. We're looking for inflation to continue to come down and the economy to continue to slow down.
That conversation just around the corner with inflation data on deck this morning at 8:30 Eastern Time, live from New York. Good morning. Closing out the week, down on the week, coming into this session, down on the day as well. We're down about 1/3 on the S&P 500. Yields just about unchanged, up almost a basis point on a 10-year 455.40. Under surveillance this morning, looking for signs of a slowdown.
We're looking for the possibility of 1 to 2 cuts at the end of the year. We're looking for inflation to continue to come down and the economy to continue to slow down. We are seeing inflation come down. I think that when we look at the next couple of quarters, we'll probably see some ebb and flow in terms of the economic outlook.
It's the latest on the outlook. Investors looking ahead to the Fed's preferred inflation gauge, PCE, due at 8:30 Eastern Time. US Treasury yields easing after downward revisions to US GDP and consumer spending. Peter Tchir of Academy Securities saying this: while my current view is the US 10-year should trade in a 4.3 to 4.5% band, I'm rethinking that. Pete joins us now for more. Pete, let's go there. What are you thinking?
I'm beginning to get worried that we're going to see another rise to that 4.8, maybe 5%, where people start fixating on the deficit. One thing that's really kind of fairly new is Japanese government bond yields. The 10-year there is above 1%. So people have alternatives now to buying treasuries. I don't think we're there. I think the slowdown in economic data is going to keep us in that 430 to 450 range. But I am worried we're going to see one of these, continued grinds higher.
Pete, that's at the long end. Can we talk about the short end, the very front end? Coming into this week, after the long weekend, the Memorial Day weekend, you said that the clients you'd spoken to aren't concerned by the prospect of rate hikes. If they're not, what is driving this?
It does seem almost crazy. Everyone I talk to seems fairly, stable, right? 1 to 2 cuts this year, a couple next year, and really doesn't care. People really don't seem to care that much about the timing. Yet the markets react to every bit of inflation data, every Fed speaker, as though it's, super important. So I can't tell whether it's algos driving it or something. And markets do seem incredibly illiquid to me. You see these kind of sloppy charts. You gap up and down intraday for no good reason. So I'm concerned that there's very little direct participation in this market. And this rally has been really driven by a lot of algos, by a lot of share repurchases. And you're not seeing a true, believer in this market.
When you talk about a lack of liquidity, is that just bonds, or are you also talking stocks?
I think across the board right now, when I look at equities intraday, right, you kind of all of a sudden, wow, we're down 8 points, 9 points on the S&P, say 0.2% on nothing. And it moves and reverses. You had a couple really weird end of day closes. So I feel like it's very algo driven and there's no true depth of liquidity. And anytime, a real human comes through with a trade, markets move. And I think that's why we're very susceptible to a fast pullback again.
Well, just on that point, I guess, Peter, there's something interesting that's been happening where if any company reports earnings that not only miss, but just don't blow things out of the water, they get punished incredibly. I'm thinking of Dell, for example, down 15% after basically having fine earnings, just not really blockbuster. Does that have a broader significance to you in terms of what might be overpriced, if not bubblicious?
Yeah, I think it does. It's, go back a few months ago, it seemed awkward that you get these trillion-dollar market cap or large market cap companies swinging 10% after earnings, and that seemed unusual, and now it's become the norm. So again, I think we're priced to perfection on a lot of areas. One thing that's been somewhat concerning is utilities have been such a good part of this market because that's been the latest kind of sector to grab this AI attention. I think we've overpriced AI. I think where AI is right now, we're overvaluing it. Companies are going to start pulling back a little bit on their purchases of it. And I think that's probably the big, decline comes from just a little bit of, air taken out of the sails of the whole AI and AI related themes.
Including utilities, Peter?
Yeah, I think so. Again, nothing's going to happen overnight, right? It's almost like we fast forward and say, okay, we're going to build data centers here, there, everywhere. So we're going to utilities are going to make a lot of money. This is going to take time. There's competition too. Like Saudi Arabia, for example, it's pretty well positioned to try and become a hub for data centers. So there's a lot of this going on, not just domestically but globally. And I think we kind of got far-fetched and too forward. Like, well, we can't buy this anymore because it's overvalued. But hey, we can buy this sector because no one's caught on to it. Yeah, people have caught on to it. It's overdone. I think that's where we see this pullback.
When you look globally, overnight we did learn President Biden will allow Ukraine to hit some Russian targets with U.S. weaponry. This will be narrow, but this is a change of policy from the White House. You write in your note, how are markets so strong with all the geopolitical risk? Is this a fresh risk that markets need to be more attuned to?
I think it's allowing Ukraine to prosecute the war more properly, I guess, for lack of a better word. And we talk a lot within our generals and admirals here. And it was kind of ridiculous that what Russia was able to do was pull across the border, recoup, rearm, and be safe while they're across the border, and then go back into Ukraine. So I think this creates a slightly more level playing field in terms of Ukraine's ability to fight, and they can kind of do an early defense, and they can attack troops as they're pre-positioning to come over. But yeah, it's going to get riskier, and I think Russia-Ukraine is going to get very volatile into the summer. Of all the world leaders, it seems Putin would probably be most interested in having Trump reelected. So anything that's inflationary, disrupts oil flow, could be good for him. So I'm very concerned we're going to see disruption across commodities this summer, particularly led by Putin.
So, Pete, big question for you. What do you like? What are you telling clients to buy?
I still like China. I think we got toppy there. We were able to take some, chips off the table. I'm reloading there. I think China's going to continue to grow. And again, I think China's going to be pushing their brands. And the China growth is not going to benefit the U.S. as much as in the past. It's going to benefit China much more. I like India still, and I do like commodities, right? I think the growth story is there. I think the potential for disruptions there. So commodities, rebuilding. And there is all of a sudden a little bit of a chance that we start hearing peace talks ahead of the election as well with Russia and Ukraine, which again, I think would be very inflationary as Ukraine would have to rebuild very quickly. So I like commodities as a whole and anything that's kind of in the infrastructure and rebuilding sector.
Something you've been saying for a while, Pete. It's going to get your thoughts. Thank you, sir. Peter Tchir there of Academy Securities. Some big moves we're seeing at a single name level. Let's check out Dow again. Lisa talked about it. That name is down by about 14% in the pre-market. The reaction from the south side, by the dip, JPMorgan, a more attractive buying opportunity. Morgan Stanley, Bramo, basically saying while near-term expectations got ahead of themselves, confidently buying the dip.
I mean, a lot of people saying this is just simply a valuation question and very high expectations that weren't exactly met. I was looking through the numbers trying to understand what the negative was. Couldn't really find it. I mean, honestly, it just wasn't a blowout kind of result. There's a broader takeaway, though, from what he was saying, which is the lack of liquidity and lack of conviction. And I wonder how much some of the economic data kind of feeds into that. We don't know where we are economically. We don't have a macro framework, so algos can be in charge. And that, I think, also speaks to some of these big moves.
Another reason why we're getting whipsawed from data point to data point. Another big data point about 2 hours away, 8:30 Eastern Time, PCE, the last big data point before the Fed's quiet period, before the Federal Reserve decision in 2 Wednesdays' times. Coming up, Ellen Wald of the Atlantic Council as OPEC Plus looks to extend production cuts. That conversation up next from New York. You're watching Bloomberg TV. The S&P 500 going 5 weeks without losses. Based on the last couple of days, that's about to change. Equity futures down again by 1/3 of 1% on the S&P 500, down 1/2 of 1% on the Nasdaq. On the month on the Nasdaq, we're higher by a little more than 6 percentage points. Thank you, Nvidia. Nvidia is up by 28% month to date. Lisa, that is $558 billion plus of market cap added to that name.
That's just unfathomable. That's more than a Walmart added to this name. I mean, basically, when you're talking about market caps of $500 billion, it really is notable that we just had the worst back-to-back 2-day performance on the S&P going back 4 weeks of a whole 1.3% decline. And basically, this is a market that has been range-bound with some massive moves in single names underpinning it.
And still trying to work out whether yields up or yields down is good or bad for equities. So let's go to the bond market. Yields are up, bad for stocks. Yields were down, bad for stocks. It's like the last couple of days. Yields were up on the back of soft auctions, bad for stocks. Yields were down on the back of bond-friendly data, according to BMO's Ian Lingen, bad for stocks. What's the read across from this bond market to that equity market?
Well, the simple read would be bad news right now is bad news and good news is bad news. That basically the idea that potentially there could be fewer rate cuts or no rate cuts could be negative for equity valuations. There's a bigger read through, though, because I don't think everyone would agree with that. I think some people might say, well, it depends on why yields are staying high. If it's economic resilience, that could be good for equities. There is a lack of upward momentum right now in stocks that has been there for much of this year. It seems like that kind of momentum trade has faded. And that, I think, is a real takeaway for me.
Do you want an upside surprise?
Yeah.
2.9% core CPI out of the Eurozone. The Euro looks like this, 108.48, positive by 0.1%. We are still expecting this ECB to cut interest rates based on everything they've told us over the last month. But the conversation about the next meeting and the one after that, Lisa, gets a little bit more interesting. And incidentally, we're talking about US yields. Look at German bund yields. Yields are near or at the highs of the year on a German 10-year right now.
This is about them, the ECB not necessarily being able to cut in July or in September or in October. And basically, it just the bar has gotten a lot higher to go further. It really has been 3 straight European CPI prints that came in hotter than expected. We got Germany, we got Spain, and then we got the general Eurozone. To me, that has to raise some eyebrows about this is a hard beast to kill globally.
Next big read, 8:30, 2 hours away. Under surveillance this morning, the former president, Donald Trump, set to campaign for re-election as a convicted felon. A jury of 12 New Yorkers convicting him on all 34 counts related to a hush money payment to adult film star Stormy Daniels. Trump facing sentencing July 11th, just days before Anne-Marie, the Republican National Convention.
Yeah, the timing is interesting. And then before all of this, we're also going to have a debate between Trump and Biden. And that, for me, really matters, because what matters to market is this conviction resonates with the electorate. And if you look at polling, the electorate looks very fickle. So PBS News, NPR, Marist poll, they say 67% of voters said a conviction would make no difference than November. Marquette Law School, though, they say that a guilty verdict would produce a 4-point lead for Biden and not guilty to a 6-point lead for Trump. That says to me the electorate hasn't really decided if this matters. And until we know that, maybe it doesn't really matter for markets.
It clearly matters for fundraising based on the events we saw take place in the literal minutes after this verdict on both sides, the Biden campaign and the Trump campaign.
And that's one thing they also agree upon and fundraised on, that this is up to the American people to decide the verdict on November 5th. Sean McGuire, I was struck by, partner at Sequoia Capital, backed several of Elon Musk companies. We know Elon Musk and Trump have been cozying up to each other, said he was donating more than $300,000 to Trump, the Trump world, because there are actually legal issues with how much you could donate to a single individual person. And this is what he said: timing isn't a coincidence. I don't see Wall Street backing down the same way Terry Haines says maybe it's a little bit harder for some public-facing Fortune 500 CEOs to come in. But writ large, if you have money, we're seeing billionaires push Trump.
Although Terry Haines was talking about the C-suites and sort of the C-suite CEOs and whether they would face more pressure. This is a hard thing to really focus on every day. Donald Trump comes out with this email: I was just convicted in a rigged trial! Exclamation point. I am a political prisoner! Exclamation point. Then people on the other side, this is justice doing its or running its course. It's people just sort of in this, fishbowl, just sort of screaming at each other, and a lot of people are tuning out. So I just wonder at what point this really moves the needle, given the fact that, everything is kind of being undermined as facts kind of get disputed with no one kind of agreeing on them.
This is the campaign for the next 5-6 months.
Okay, thank you.
And it picks up in a much bigger way in about a month from now. That first debate is going to be absolutely huge. I think maybe even more so for the sitting president, how he navigates this issue now. I think for a lot of people, they felt yesterday he should stay away from this. He should stay away from this. And he's going to be able to stay away from it for the next several weeks. Can he on the debate stage a month today?
Well, I don't know whether Donald Trump will let him. He'll say, he'll make this a mainstay of his campaign. He already has in the fundraising. So how does he respond to that without alienating people? And there are the Trump supporters and there are the never Trumpers and all the people in between. How do you sort of get them on board or not?
3 reasons why, according to Politico, Biden aides say that they're putting a little bit of daylight between them and this verdict. 1, there's no need to spike the football when the conviction is already dominating the news. 2, polling suggests the race will turn on other issues, so seizing the conviction potentially could be a trap. And 3, they can always readjust. They can always say, all right, we're going to move now, but let's wait, see the dust settle.
Libby, Cantrill, PIMCO, that conversation about 30 minutes away. Don't miss that. Let's turn to the Fed speak. Fed President John Williams saying there's ample evidence that monetary policy is restrictive. President Logan adding policy may not be as restrictive as believed, but there's good reason to think we're headed to 2%. We'll get some data a little bit later this morning, 2 hours from now. But you just compare what we heard from Williams from what we heard from the former New York Fed President Bill Dudley right here on Bloomberg, and they are 2 very different views about how restrictive policy actually is.
You think that John Williams read the column, right?
I think so.
Yeah.
I think he probably did.
Or he watched Bloomberg.
Yeah, clearly. Well, John, I will say it seems like a pretty direct response. So I think we got the message that basically the mainstay, which is Powell and John Williams, they are 2 of the 3 biggies on the committee, expect this to continue to be ongoing disinflation and that rate cuts should pick up speed. What then is the influence of the Kashkaris in the world, of the Logans in the world that come out and say, maybe we are dealing with a new framework, kind of echoing what Bill Dudley said?
Being restrictive or not is not much of a debate. Being sufficiently restrictive is the debate going into the FOMC next week, without a doubt.
Absolutely. In other words, how much further do they have to go? How much longer do they have to leave rates where they are? This concept of how much downward pressure is the current 5.25 to 5.5% rate putting on the economy is subject of massive debate. No economist can agree on this. So the fact that the Fed has to come out and rule on this, good luck. We feel for you.
Just a little bit of Fed speak later, and then we're done. Into the quiet period through next week, and out the other side, 2 Wednesdays away. An FOMC rate decision. Let's turn to OPEC. OPEC Plus meeting this weekend. The group of crude producers expected to extend voluntary cuts through the second half of the year. Bloomberg reporting cuts may stretch into 25 as exporters look to compete with record US output. Ellen Wald at the Atlantic Council joins us now for more. Ellen, it's wonderful to catch up with you and get your perspective on this. We've seen before OPEC Plus meetings last 10, 11, 12 minutes. Is this one different?
I think this one is different because they're trying now to put together a much longer production cut extension. They're looking now well into 2025. And the issue there is that they want to reduce some of the baseline production capacities for some of the different OPEC producers. Remember, we've got some really old production capacities that no longer reflect accurately what these countries can produce. And so they're kind of using this production cut extension as a way to compel these countries to accept new quotas and new baseline capacities. And so it could take a bit longer, though a lot of this gets done behind the scenes. So as long as they've gotten agreement from everyone before they go into the meeting, it could be pretty short.
These Saudis, as you know, don't give us a price target. We all wish they would. Right now, the price is 81.45 on Brent crude. Is that the sweet spot for the Saudis? Are they comfortable with where price is and has been over the last few months?
I do think the Saudis are very comfortable with prices in the 80s. I think they prefer maybe more mid 80s if you want to get really specific. But anywhere in the 80s, I think the Saudis think is pretty good for them. Once you hit closer to the 90s, they tend to get kind of nervous about demand destruction. But that's just the Saudis. You've got other OPEC members definitely want to see prices on the higher end. They'd love to have prices in the 90s, but the Saudis always take this view that too high is not beneficial for them or for any other producers. Obviously, too low is not so good either.
When it comes to messaging, Ellen, what's the message for the fact that they decided to do this remotely and not in person, looking at each other, flying somewhere?
Yeah, I think that's a really good point. I was just thinking about that before coming on, and I think that the issue is mostly they want to try to avoid the spectacle, which is interesting because I think before they really embraced the spectacle, but I think they've come to realize that the spectacle can create more controversy and drag things out longer, and that if they can kind of get everything done remotely beforehand on their WhatsApp group and whatnot, that it actually results in a lot more conformity and a lot. It's much easier to reach a consensus that way.
How much is the discussion kind of not being had out loud? The quiet part is that the U.S. is really a major competitor, and that the more that they cut production, potentially they lose share to the United States that could be exporting more and is pumping 13 million barrels a day. How much is that kind of going to be on the front and center in terms of discussing strategy?
Yeah, I think that's a big issue for them, but I do think that they're looking at the wave of recent acquisitions and they're seeing something really positive for their group, because the fewer players there are out there, the more incentive there is for companies to curb their own production. And so now we're talking about, instead of having so many little companies all over producing and drilling just to break even or if they can, now we're talking about the huge consolidation. Lots of these companies are now under the umbrella of larger producers. And so I think that they are looking at this and saying, hey, it's not so much the wild, wild west out there anymore. And I think that gives OPEC the ability to look farther into the future. They can say, look, coming down the road, yes, the U.S. is a big producer, but I think that they can expect them to act a little bit more conservatively, perhaps, in terms of production, because a lot of the wells are under the control of the same company. So I think that they're looking at this and saying, hey, we can plan more for the longer term now.
Bloomberg opinion writer Javier Blas recently wrote a piece about the hodgepodge production cuts. There's the top line that pretty much everyone has to cut. Then there's subcuts, voluntary and compensation cuts. Can you make sense of this? Is OPEC potentially muddying the waters by doing this in this fashion?
It's so confusing. Sometimes I wonder if only, the guys who work for OPEC actually know what's going on in terms of all the numbers, and that they've so confused everyone, including themselves, that they just agree to whatever Abdulaziz bin Salman proposes. So he definitely has a very good point there. I do think that if they can redo the production baselines, that will generally alleviate a lot of the confusion that goes on, because some of this is very confusing, because we don't really know, because these cuts are based on very old baselines, and if they can really redo them all, then I think that would alleviate some confusion. Of course, that remains to be seen.
We're going to peak driving season in the United States, and we had Republicans in Washington send a letter to Secretary Granholm saying, do not tap the SPR. It's under my understanding that if we get north of $4 a gallon of gasoline, that's a potential lever this administration is going to pull. Ellen, how do you read the situation going into the summer?
Yeah, I think that they're really concerned about this. I do think that the move to tap the gasoline SPR in the East Coast is not, they're playing it as a way to bring down gasoline prices this summer, but really it's a result of the fact that it's really expensive to store a lot of gasoline. And this particular gasoline SPR was just put in place after Superstorm Sandy, and they're realizing they can't store all this gasoline for that much longer. Let's put it on the market. So I don't think that the SPR itself is designed to be used to lower gasoline prices. And if they keep tapping the SPR as a way to relieve high gasoline prices, they're going to find themselves in a really bad situation when, say, there's a big hurricane that knocks out production in the Gulf, and they haven't got the SPR that they need to alleviate true shortages. So it's really a delicate balancing act here. And there are other reasons why gasoline prices get very high. It has to do with refining. We've cut back on, we don't refine nearly as much as we used to. A lot of our refining has been switched over to biofuels, which are not nearly as useful or necessary as gasoline. So there are other things that they could do to help alleviate a gasoline crunch or gasoline price crunch that don't involve using the SPR.
Ellen, thank you. for that final word. Alan Wald there of the Atlantic Council, the SPR, the political battle of 2024.
Yeah, although we were talking to the person at Gas Buddy, and he basically was saying it's not going to be needed because prices are going down. But yeah, we're going to see. I mean, the fact that they're even sending these letters out.
I know. Well, they know where this is going. If crude prices spike, they know exactly where this is going.
Right. So they want to sort of lay the groundwork of, ire.
$4 a gallon on gasoline is going to really start to unnerve some members of the White House. And imagine it hits $5. This is the summer before an election. They're going to have to pull a lever.
The WTI down on the month by about 5%, biggest monthly drop of the year so far. So for the White House, at least, that might be what they want to see. For OPEC Plus, I'm not so sure. Within this sweet spot right now, apparently, according to Alan Wald.
Yeah, that basically they'll try to keep things status quo. I think that's the message, frankly, for why they're just holding it remote. It's basically, we don't want to make waves. Just let's zoom in and be lazy.
WTI about 77.89. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Bill Ackman is planning an IPO of his investment firm Pershing Square as soon as next year, according to the Journal. People familiar say that as a precursor to the listing, Ackman will sell a stake to investors in the coming days with a valuation of about $10.5 billion. It's a chunky figure for the fund. For context, Brookfield has just a slightly higher valuation, but manages $925 billion versus Pershing Square's $16 billion. IPOs have also been challenged this year, save for the tech blockbusters. Paramount Global shares up in the pre-market trade 1%. That follows a report that Skydance Media submitted a sweetened offer for a merger with the company. Paramount's independent committee is set to review the offer shortly, that according to the Wall Street Journal. In recent months, Sony, Apollo, Warner Brothers Discovery, and media executive Brian Allen have all expressed interest in Paramount. The NBA Finals matchup is set. The Dallas Mavericks are the champions of the Western Conference after beating the Minnesota Timberwolves last night. The Mavs took the series in 5 games with a statement performance from their star duo, Luka Doncic and Kyrie Irving. They'll be facing the Boston Celtics, who are coming off of their sweep of the Indiana Pacers. That series kicks off next Thursday in Boston. That's your brief, John.
Hey, Danny, thank you. We'll catch up with you in about 30 minutes' time. Up next on the programme, Diverging Paths.
As a general perspective of the broad European economy, it's going to need more rate cuts than the US. So as you look at it from that perspective, that rate path does add to the attractiveness.
The ECB decision, a week away. The week after that, the Federal Reserve. All of that coming up next from New York. This is Bloomberg. Equities on the S&P 500 pulling back negative here by 1/3%. Yields a little bit higher by a single basis point, 456. Under surveillance this morning, diverging paths.
As a general perspective of the broad European economy, it's going to need more rate cuts than the US. So as you look at it from that perspective, that rate path does add to the attractiveness. Now, I don't know how long it's going to be sustained. Are we looking at this as a long period of outperformance where US exceptionalism is dead? I won't go that far, but I do think that this is a tactical opportunity at this point in time.
So here's the latest. Eurozone inflation picking up this morning more than anticipated ahead of next week's ECB decision. The central bank widely expected to cut rates on Thursday, months ahead of a possible move by the Federal Reserve. Sree Kochugovindan of Aberdeen writing this. The ECB won't be deterred from cutting, but there could then be a pause. And they may wait until the fourth quarter or even later to cut again. As for the Fed, we expect rate cuts to begin in September. Sree's with us right now. Sree, we've talked a lot about central bank divergence, the ECB going, the Federal Reserve going nowhere. From what I see in your research, you think there are limits to that divergence. Could you walk us through it?
Well, I think there is a bit of a sequencing in terms of timing, in terms of when they actually start the easing cycle. So obviously from the ECB, we've had some inflation data out this morning, but that's not necessarily going to change the timing for the start. Christine Lagarde has already committed to June, but then we could see some staggered beginning for other central banks. So, for example, Bank of England, there is already market pricing has pushed out the timing towards later on this year. So that June easing, the very first cut, that's unlikely to happen now. So really, it's a staggered easing cycle. But then we do have this common theme in terms of very sticky services inflation, core inflation. That underlying trend is proving to be a little bit stubborn across the different countries. So that really poses a question how much can they ease after that? So that's really the debate amongst a lot of investors at the moment. It's, yes, they'll start cutting, but then will there be a pause? For the ECB, as a case in point, will there be a pause after that? How quickly can they start easing from here?
Let's sit on the ECB and the Governing Council. ECB President Christine Lagarde has done a pretty decent job of keeping a consensus together on the committee. Sree, do you think that typical north-south divide is going to reappear on the Governing Council as we start to have that fight beyond June and deeper into summer about what to do next?
I'm not really sure there's going to be a big division within the ECB itself. I think really what they're signaling is data dependence. There are some more hawkish voices within the ECB. However, there is still that consensus with regards to kicking off that easing cycle. They don't necessarily need to be as restrictive as they are. But then it'll be the timing. Perhaps we could see the next rate cut later on in Q4 from the ECB and a quicker pace as we move into 2025. Really, it's about that disinflationary path, which is already well underway, but there are some bumps in that final part, the final mile that everyone is talking about. Really, that's where the focus is going to be. So it does seem more data dependent. If we move to the Fed, however, there's a little bit more of a division already within the Fed, and we do see some members who are talking potentially about delaying rate easing, not just delaying, but actually moving into, some talking about rate hikes even. So we actually think that the most likely scenario for the Fed is that they start easing in Q4, most likely September. But again, this is very much dependent on what we see later today in terms of the core PCE outlook and the trend thereafter. Again, very much the key problem, the common theme is that stickiness in service wages and services inflation.
Sree, to John's point, though, there is this question about just in general the different regions of Europe and how they're benefited or not necessarily when it comes to particularly euro that could be weakening. I can think that Southern Europe, for example, during vacation season might welcome a weaker euro while you get Germany kind of pushing back a little bit more with some of the goods that they export for manufacturing becoming more expensive. How much does that sort of color the debate on the ECB in a way that is different than for the Federal Reserve?
I think it's true. The ECB is obviously trying to manage a number of fairly diverse economies there. But even when we look within that, I think Germany obviously has been quite key in this morning's number, in driving this morning's number. There has been some technicalities there that have led to, the cheap transport tickets, that base effect has led to a bit of a stronger number there from Germany, and that's had an impact on the aggregate inflation number. However, these technicalities are likely to unwind. Going forward, obviously, there are slightly different focus, as you mentioned. Those economies are responding to the trends in the euro in a different way. But nonetheless, the ultimate mandate for the ECB is to look at those aggregate numbers and to see where the inflation trends overall are going and looking at that, the overall good for the euro area economy. It's very difficult to try and nuance it according to Germany versus southern economies as well.
Just real quick here, Sree, is the inflation in Europe similar and more similar to the inflation in the US than many people thought?
I think in the US, obviously, the economy has been a lot more resilient there. And that's been a key difference, I would say. Euro area is recovering out of some weakness, some recessionary vibes that we saw in the end of last year. So there's a bit of a recovery there. But US has been remarkably resilient, despite the fact that we've had such aggressive rate hikes. And so this is a key difference, I think, in the two economies in terms of the underlying drivers of wage growth. There are some similarities, obviously, as you mentioned, with service sector inflation. But it does seem that in the US, it's correct that they would wait before they start easing. And it's also correct that ECB doesn't have to wait for the Fed. There was a debate earlier on, do they have to wait? Does everyone have to wait for the Fed before they start easing? That's definitely not the case. And we're seeing that very clear in the message where each central bank is very much focused on domestic drivers now, The pandemic-related global drivers, they've unwound. And here now it's really looking at the timing. The sequencing of timing is different because of the relative strength of each economy. So US, I'd say the big difference there is the resilience in consumer spending. And that's starting to slow. And that's another feature that we're going to be monitoring over the course of the coming months.
Hey, Sree, we've got to leave it there. It's good to catch up. Thank you. Sree Kochugovindan there of Aberdeen. On the next hour, in Bloomberg Surveillance, PIMCO's Libby Cantrill, Sam Stovall, CFRA, Delta Airlines CEO, Ed Bastian, Bob Michael of JPMorgan from New York. This is Bloomberg.
It's not unreasonable to worry about inflation.
We are seeing inflation come down. I think that when we look at the next couple of quarters, we'll probably see some ebb and flow.
We're kind of optimistic about inflation in the near term.
To get to that July cut, you would need probably some combination of soft enough labor market data and enough decline in the run rate for inflation.
The Fed's not going to be cutting rates because inflation is magically back down to target. Maybe cutting rates because all of a sudden they have to start worrying about the labor market.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
90 minutes away from inflation data in America. That's all Rhame wants to talk about. No politics, all economics and Fed speak. You take the Fed speak.
You're welcome.
Take the Fed speak over US politics right now.
Well, what more are people going to say? They're the people who are entrenched in saying that this is a rigged trial, which is what Trump is saying. And then there are people saying, look, this shows that justice works and that a jury of 12 peers were able to convict him. And you're not going to get any cross dialogue between the two. So there's your in sum from me.
These are the dates for your diary, the dates that Lisa won't be at work. Here's the first one. June 27th, big debate taking place next month. July 11th, Trump sentencing. And then July 15th, the RNC.
The RNC, where they're going to basically say this is our candidate and he is a convicted felon. As of yesterday, 34 counts he was found guilty on. Though Lisa is less excited about all this, it is unprecedented times. What really matters to the market is, does this shift the narrative for the electorate? And I think in the polling we've talked about throughout this show is the electorate looks fickle on whether or not this actually matters to if they're going to cast a vote for Trump or Biden. What is key, though, both of these individuals, Biden and Trump, came out yesterday fundraising on this, saying it's November 5th that matters for the verdict for the American people.
Just to be clear, it's not that I don't find it interesting. It's just that right now there are the people who are tuned in and kind of going with what they already believe. And then there are people who feel further tuned out just because it feels like this doesn't ever matter the way that people think it's going to matter one way or another. So it becomes exhausting and it leads to this feeling disenfranchised by so many people who are not hardened on either side of the political aisle.
If you were going to vote for Trump before yesterday, you're probably still voting for Trump. If you were going to vote for Biden before yesterday, probably still voting for Biden. What the independents do, and this poll from NPR and PBS that we've been referencing through this morning, Anne-Marie, 2 in 3 registered US voters say a guilty verdict would have no effect on whom they plan to vote for in the presidential election. What they decide to do could be very important.
That's right. That poll, 67% of voters say conviction would make no difference in November, including 74% of independents. That's the key part of this poll. But again, to my fickle electorate, Marquette Law School polling, they talked about the fact that a guilty verdict would produce a 4-point Biden lead in national head-to-head matchup with Trump, while a not guilty verdict would have resulted in a 6-point Trump lead. This is why the debate is going to be interesting. Who moves the needle after the debate?
That debate, a month away. Equity futures right now. If you are just joining us, welcome to the programme. Plenty of market coverage, I promise you. Equity futures down 1/3 on the S&P. Lisa excited for PCE.
Oh, yeah.
A little bit later this morning. Yields up a single basis point, Bramo. The 10-year, 455.60.
Well, just think about the second read of GDP that came out yesterday, the fact that there was a bit softer consumer spending and that there was a bit softer kind of core inflation read. Move the market. Just think if we get a surprise one way or another. That's true excitement, and that's what we could get. In about 90 minutes' time. The whisper number is actually for the lowest read going back till December.
There we go. We can see what Bramo's excited about. Coming up this hour, PIMCO's Libby Cantrill, as Donald Trump is convicted on 34 criminal counts. Delta CEO Ed Bastian sitting down with Guy Johnson on the airline's outlook for the summer. And Bob Michael of JPMorgan Asset Management still looking for a September rate cut. We begin with our top story, a groundbreaking moment in US history.
This was a rigged, disgraceful trial. The real verdict is going to be November 5th by the people.
Here's the latest. A 12-person jury finding former President Donald Trump guilty of 34 counts of falsifying business records to conceal a hush money payment to an adult film star, with sentencing set for July 11th, just 4 days before the GOP convention. Bloomberg's David Gura is outside Trump Tower here in New York City. David, good to catch up with you, buddy, as always. What's next for the former president?
Well, we're going to hear from him later today. He's going to hold a press conference at 11 o'clock in New York, and that's when he's going to try to move this from that legal arena into the political one more fully. And picking up on what Lisa was saying, respecting what she's saying about this being kind of an intellectual exercise and people's views on this being so calcified, I think we're at this moment where it's yet to be determined how much this resonates with the U.S. electorate. And what we're going to hear from the former president today is an effort to kind of situate this in politics, in the campaign, yes, to cast aspersions and doubt on the proceedings that just ended yesterday, but also to look ahead squarely to the general election on November the 5th. Now, of course, July 11th looms large. That is the sentencing date. And so here we are in this kind of strange vacuum where there'll be filings in that matter, sort of what each side thinks the sentence should be, if there should be a sentence at all, I assume, on the part of the defense. And then the appeals process will be underway as well. And all the while, this effort to raise money off of what happened yesterday on both sides, to sort of do a very delicate ballet around what's happened here. You saw a tweet from President Biden yesterday, also looking ahead to the election in November, this awareness that, yes, this is a significant moment, an historic moment, an unprecedented moment, but what does that really mean? How is the country going to react to this? And that election date, that general election date, being the sort of moment when this truly will be sorted out. And I will just add as an addendum here, and I think it bears mentioning over and over again, what transpired yesterday, that guilty verdict, being guilty of those 34 felonies, does nothing to neuter the president's ability to run for re-election in November.
David, what's been the reaction from Wall Street? Any indication you've seen that they're shying away from potentially pouring money into Trump?
No, I think quite the contrary, actually, Henry. So you look at a story that Bloomberg has out this morning, kind of taking stock of the way that Wall Street is headed here. You know, a few days ago, we had Steve Schwarzman of Blackstone throwing his support fully behind the president after he cast doubt on the virility and viability of that campaign. We're seeing reports now that Bill Ackman, the hedge fund manager, is close to endorsing Donald Trump as well. So if anything, I think we're seeing among top financiers a willingness to embrace this candidate in a way that they hadn't before. And I think that bears watching as all of this goes forward. I think they, from the commentary that I've read thus far, what we've heard from those people, sort of see this as an aberration, as something that's a distraction from the policy matters at hand and sort of the general election more broadly. So they seem to be at the vanguard here of, again, casting doubt or throwing shade on what happened here yesterday and looking ahead to the election in November.
David, looking forward to your coverage throughout today on Bloomberg TV and radio. Bloomberg's David Gura with us around the table here in New York, PIMCO's Libby Cantrill. Libby, good morning to you.
Good morning.
What changed yesterday? What are you telling clients?
Yeah, so I think your analysis before David Gura's segment was exactly right? This is going to embolden the base of each party. What we saw yesterday was that Republicans on Capitol Hill had one of their most successful fundraising days in history. So this will be great from a fundraising perspective. It will be great in terms of emboldening the base. But really where it matters, John, and I think it's way too early to tell, is how does this influence that independent voter that you were all referring to, that suburban voter? This election likely will be very close. This election will likely be determined at the margins. So any sort of marginal issue that may move that marginal voter actually matters. But it's too early to tell. 5 months before the election, what we have been telling our clients sort of incessantly is it is too early. It is too early to have a high conviction, particularly at the top of the ticket, either way. And I think what happened yesterday just simply underscores that.
What does each camp need to say to the independents to make sure that when November 5th comes, they cast a vote for their party?
Yeah, so I think that's a really important point, because it's not only this event that happened yesterday, but it's how each candidate actually responds to the event. So does President Biden, for instance, use this as an example to sort of pivot to issues that Americans really care about? As you said, a lot of Americans are disillusioned, they're discouraged, they're befuddled by the choice in front of them. They don't want to talk about this. They want to talk about the future. So can Biden compartmentalize this and then move to the future? And then for President Trump, can he can he also, I mean, he's going to use this for fundraising, and that will be, successful for him. But can he also then appeal to that middle of the country in terms of his his vision going forward? Because elections are about the future. They're not about the past. And if he is just relitigating the past, again, that could hurt him with this marginal voter.
But for the Biden campaign, they need to be careful, right? This is a fine line they need to walk. Do they just come out and say Trump is a felon? Or can they actually go further without looking like they're benefiting from what Trump is calling this a politicized case?
Yeah, so I mean, I think it is a delicate balance. But President Biden needs to make this a choice between the two candidates, not just a referendum on him. However, what you saw yesterday, I think, is probably going to be indicative of the Biden campaign response, which is just saying, justice has run its course, and we're focused on other issues.
I do wonder if there's a broader takeaway. You talk about how people are feeling disillusioned, disenfranchised, this sort of frustration. We're seeing that in a lot of youth polls, in particular, as people are sort of befuddled as to why we have this combo. Is there any larger implication, though, for the political system and what's going to transpire after this election as a result not only of this prosecution, but also just in general how this is playing out?
Yeah, well, I think, we're really focused in between now and the election, but in
I'm
terms
trying to
of
think behind it. Can you tell?
I'm very quick to pivot to 2028. Let's talk about the 2028 presidential cycle. Okay. Let's talk about that, guys.
All right.
No, but I do think this is right? I mean, this is, and we sort of joke, this is the election that very few people want. If you look at polling, between 50 to 70% of Americans don't want either candidate to be the next president of the United States. And I do think that it has maybe some practical implications running up to the election. I mean, what is voter turnout? There is a real risk that this is a low turnout election. Now, I think the question for political analysts is who does that help? Because historically, low turnout has actually helped Republicans and high turnout has helped Democrats. Because of the realignment of the parties, that actually, the dynamic could switch.
We are starting to think about the inflationary outcome of this election. To be fair, there is a policy conversation going on.
Thank you.
I know maybe not yesterday afternoon, but it is happening. What are you saying at the moment about who is going to be the bearish candidate? And I know that's super, super difficult to draw a conclusion on.
It's super difficult, Jeff.
But I'm starting to hear from people like Matt Lazzetti at Deutsche Bank, who is saying this Federal Reserve might have to stay on hold for the whole of 25 if we get the kind of tariffs that the former president is talking about. Where are we on all that stuff at the moment?
Yeah, and honestly, this is exactly what our clients want to focus on. They don't want to focus on the horse race. They do want to focus on, Lisa, to your delight. They want to focus on the policy implications. I mean, I do think really it will be likely a mixed picture, but under a Trump administration. But it's going to be so dependent on, as we've talked about, the composition of Congress. Also, what does he do exactly what he says he's going to do? Now, on tariffs, on immigration, that is where we think that there could be an inflationary impulse. Of course, tariffs are likely going to be inflationary. That's what we saw with the original Trump tariffs on China. They were basically completely passed through to the consumer. Now, the question is, does he really put 60% tariffs on China? Because, and Anne-Marie and I have talked about this, that this not only has an inflationary impulse, but also has actually, maybe even more so, an impact on growth. So for the Fed, that is that could be a conundrum. Again, should he put the 60% tariffs on China inflationary, but if anything, you could actually have a more severe impact for growth. So I think, John, the bottom line here is there's a lot that's unknown and difficult to sort of prognosticate the Fed's behavior going into 2025 when, again, there are so many unknowns.
When it comes to something like tariffs, Trump could do that unilaterally pretty quickly. But the composition of Congress matters for basically everything else. What's your base case for the House and the Senate?
Yeah, so I think that tariffs and then also on immigration, there are things that he can do on both on terms of the flow of immigrants and then also importantly on the stock of immigrants. And we know that immigrants have actually had a pretty profound impact on the economic circumstances of the country over the last year or so.
Thank you.
But exactly, John. Sorry, we should point that out on every segment that we're talking about politics.
Thank you.
Immigration is so important.
Single-handedly boosted the GDP.
Yes, but anyway, but in terms of fiscal policy, most importantly, that is what resides with Congress. And does what happened yesterday impact these down ballot races? is, maybe. What we do know, of course, is that the Senate is incredibly vulnerable for the Democrats, which hold the Senate only by 1 vote. So pretty high odds that we could see the Senate flip. The House, I think, is really an open question at this point. And this is where actually, because the House is much more of a national election, the Senate, only 34 of the 100 Senate seats are up for re-election. So I think that these types of things that happened yesterday can actually influence the direction of the House. But again, too early to say.
Too early, but we're talking about it.
Libby, we're talking about it.
Libby Cantrill of PIMCO. Talking about it because Rhame might go nuts if we don't. No, we carry on talking about the events of yesterday.
That's so sweet of you. I haven't already gone nuts.
Done this just
That's
for
kind.
you. 1 hour, 15 minutes away from PCE data in America. Equity futures down by about 0.2%. Let's get you an update on stories elsewhere. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Dallas Fed President Lori Logan says that policy might not be as restrictive as believed. Because of that, she said, quote, it's important to keep all options on the table. That, though, contrasts with New York Fed President John Williams, who said he sees ample evidence that policy is restrictive, and doesn't believe that the neutral rate has risen. It is a rare but perhaps growing divergence among Fed officials. Tesla shareholders are being urged by a proxy advisor to reject CEO Elon Musk's $56 billion pay package. ISS says the compensation plan was, quote, outsized from the start. Back in January, a judge in Delaware struck down Musk's pay package, saying the company's board wasn't fully transparent with shareholders when they made that deal. And New Yorkers will get a taste of international cricket over the next few weeks. A 34,000-seat temporary stadium has been constructed on Long Island. It will host 9 matches of the upcoming T20 World Cup. Tickets for the showpiece match between India and Pakistan sold out immediately. Tickets on the secondary market start at around $1,300. That's your Bloomberg Brief. John.
If anyone wants tickets, Anne-Marie has some. Very keen on cricket after her time in England and looking forward to the big event, aren't you?
Oh, yes, John. Remember, what did I call it? Cricket reminds me of Quidditch.
Quidditch, yeah. I've forgotten about that.
Yes, she wanted to repeat
truly
that.
Insulting. Coming up next on the programme, I don't really care. The calm beneath the surface.
For the majority of companies, they're seeing relatively moderate growth. We think equities are going to be pretty much sideways for the next few months.
I can't pretend I care. How dare you? Is that my posh voice? Did that work?
I know you don't want to go to cricket. You want World Cup.
I'd love that.
I'm working
make
on
that
it.
happen. Make that happen. That conversation, not that one, but the one we were talking about before, is up next. From New York, this is Bloomberg. Equities just a little bit softer this Friday morning. Good morning to you. We're down by 0.2% on the S&P 500. Under surveillance this morning, the calm beneath the surface.
The rest of the market is not seeing anything like the kind of growth of that small number of large companies. And while the index has gone up because of the weight of these super large tech stocks, for the majority of companies, they're seeing relatively moderate growth. We think equities are going to be pretty much sideways for the next few months.
So here's the latest. Futures edging lower ahead of key inflation data 8:30 Eastern Time. The S&P 500 poised for another month of gains. For the month of May, we are down on the week. Through Thursday, though, Sam Stovall of CFRA writing this. It's been rumoured that between Memorial Day and Labour Day, investors focus more on their tans than their portfolios. The S&P 500 gained an average of only 1.6% in price between these two holidays since 1945. Instead of experiencing the summertime blues, it frequently enjoys a summertime snooze. Sam joins us now for more. And hopefully, Sam, you'll wake us up a little bit more than that. Sam, what are you advocating for then for clients through the rest of this summer? To sit back, chill and ignore everything?
Well, good morning, Jonathan. I think certainly there's a lot of reasons why one might say that this Memorial Day through Labor Day period might be quite different from other election years since World War II. Certainly now we know that AI has been driving tech and semiconductors, but EI has really been driving the rest of the market, EI being earnings and inflation. And now with the worry once again that the Fed could be raising interest rates, possibly staying higher for longer, causing a recession. I think that's what's, in a sense, causing cracks to form underneath the confidence of investors today.
So does that mean that, Sam, you think that people shouldn't go try to tan and they should actually be in the office actually trading because otherwise they could lose their shirt?
Very good, Lisa. I like that one. No, I think that what we typically find is that many of the groups, while they do tend to tread water, investors do tend to gravitate toward the more defensive areas of the market. I always say that you are much better off rotating than you are retreating in this traditionally stayed period of the year. And it's usually those areas like staples, healthcare, utilities, et cetera, that have done well. But I guess this time around, what we're seeing is that since the Dow hit 40,000, really there's been no place to hide. The market really has been selling off quite a bit, with technology being the only group that's still in positive territory.
And it seems like any kind of miss or even in line that isn't necessarily off the charts for some of the biggest winners this year have been punished severely in terms of market reaction. I wonder if there's a larger takeaway, though, and we were exploring this yesterday with Peter Oppenheimer of Goldman Sachs, that at this point, at this level, based on how much yields have moved up, that is going to be the tail wagging the dog when it comes to the equity markets. If the further the yields go up, the more punitive it becomes for the stock market. Do you believe that?
Oh, yes, because I think that's the real factor that is causing concern. I mean, our expectations had been that we would see a gradual decline in the 10-year yield as the year progresses. And so obviously with it going in the opposite direction, that makes us sort of second guess our own opinions. And I think the same is being done by other investors. So our belief still is that the Fed will be cutting twice this year, September and December, obviously knowing that now September is more like a coin toss as to whether that will happen. We also remind investors that every election year since 1992, except 2012, had the Fed either raise or lower rates prior to the election, many times occurring in September. So I think the Fed would love the opportunity to show that they are apolitical should the data allow for that.
Sam, if September's a coin toss, what does the Fed need to see in the data before September to have that confidence to cut just before an election?
Well, I think they're going to have to see today's PCE, and successive PCE indicators show continued downward trend. I think we're likely to see the unemployment rate maybe tick up a couple of basis points, and also just see that maybe the second quarter GDP does not come in as the Atlanta Fed is anticipating at this point, well above the 3% level. So I think the Fed is basically going to be sticking to its mandate by saying, can we see inflation come down while not having a material impact on employment?
Sam, I just want to take the conversation, finish this conversation somewhere where Lisa's been leaning, and I think it's an important conversation. What's happened with Salesforce in the last 24 hours? Down by about 20%. What happened with, say, Dow? Dow down by about 15% in pre-market. The Dow numbers, to Lisa's point earlier this morning, they weren't terrible. In fact, they were a beat. It just wasn't a big enough beat, and you're seeing a monster move in quite a sizable company, Sam. And I'm wondering from you and the team at CFRA, the kind of signal that you're taking away from this kind of price action.
Well, I think, as Lisa was saying before, that companies are being punished if they don't meet the published numbers or even the whisper numbers. Technology for this first quarter is showing a 25% gain in earnings versus the earlier anticipated 20% rise. Also, we've seen an improvement in not only 2024, but also 25 estimates, now 20% for the sector in 2025. But it continues to bump up against the 30 PE for the sector itself on forward 12-month earnings, which has resulted in pretty much a locked ceiling, if you will. And so with these numbers really at stretched valuations, I think there is the need for the resetting of the dials, at least in the near term.
Certainly seeing that as some single names, that's for sure. Sam Stovall there of CFRA. We're talking about a 20% move on Salesforce, which is a big, big company. That market cap move, I think, was something like 52 billion in the period, which is, some hefty chunk of change, which I know we've sort of gotten used to because we see these big moves in Nvidia, but still, that's a sizable move.
Especially at a time when the reason why really is just simply that AI adoption isn't going to really monetize that quickly for them, that it's going to take until next year or the year after for them to really reap the financial gains from this. If you take a step back, I wonder how much people are getting worried that artificial intelligence and the hopes of how quickly it's going to be sort of borne out in lots of different industries, if they're worried that maybe we've gotten over our skis a little bit with that narrative.
Yep.
And that's how I really read a lot of these moves.
With the exception of Nvidia, which has just surged again through May. Saw a similar move on American Airlines, a move of 13.5% lower a couple of days ago off the back of their change to their outlook. We want the outlook from Delta. We'll get that next from the CEO. And Bastian sitting down with a brilliant Guy Johnson. That conversation just around the corner. Equity futures right now on the S&P 500 negative by 0.25%. The main event in the economy, at least, for the Federal Reserve and for markets perhaps as well. The PCE data, 1 hour away. "60 minutes away from PCE data in America. Equity futures on the S&P 500 negative by 0.2%. Another read on inflation. Going into all the Fed speak. Going into the weekend, then you won't get any. I know that's good news. There's a lot that Lisa's excited about this morning. The inflation data in about an hour.
Yep.
Lack of Fed speak after the weekend.
Yep.
Feeling good, aren't you? Let's get you to that weekend. Futures look like this. We're down 0.2% on the S&P. We're negative 0.4% on the NASDAQ. The scores in the bond market, a 2-year, 10-year, 30-year, that shape up as follows. 494, we got really close to 5%. We've seen 5% once this month. It was the first day of May. And Lisa, since then, we backed away. Then we got closer in the last couple of days and we backed away again.
It's hard to know exactly how much credence to put into this because, as Peter Tchir was saying, it seems like there's a lack of liquidity. And as Sam Stovall was saying, there are people who are trying to go to the beach pretty aggressively. That said, there is this feeling that Lori Logan really crystallized, which is we don't really know how restrictive rates actually are. We can say they're sufficiently restrictive or you cannot. We don't know. And with that ambiguity as a framework, I think you could see some of these auctions really whip around the action, especially with a dearth of other actionable news.
I think it's a recipe for a really interesting conversation on the FOMC in 2 Wednesdays' time. I think it's going to be very interesting to see how that debate takes place, how the chairman tries to reflect the lack of consensus in the news conference, because we've seen some daylight between him and the minutes a few times.
At this point, how much does he address R-star, this idea of what the neutral rate is long term? Some people call it a fiction. To me, it seems like Jackson Hole is going to be a real moment because they're going to have to come out and they're going to have to make some sort of proclamation about how they've engaged this or a strategic framework of how they filter in data points that seem to matter or not, depending on the day.
TK stopped me on the way out the door yesterday. Are we going to Jackson Hole? Shall I book my flight? I said, plans are coming together. We're trying to make that happen.
Are you booking that?
We're trying to make that happen.
You're arranging it in the background.
Yeah, let's see. End of August. Something else happening at the end of August too, right?
The DNC. That's where I'll be.
So there you go. It's a lot of events coming up this summer. Under surveillance this morning, let's talk about the politics. A New York jury finding former President Donald Trump guilty on 34 counts of falsifying business records. Sentencing is set for July 11th, just 2 weeks after the first presidential debate. And Anne-Marie, 4 days before the RNC.
Where they're going to crown that 100% Trump is going to be the nominee going into the November 5th election. And this all comes down to how do the voters feel about the fact that Trump was guilty on 34 counts? That's what the markets care about because what the voters decide potentially will shape this election. Going into this verdict, the polling has been very murky. It's a fickle electorate, which is why how they campaign is going to be interesting. And the start of that is going to happen at 11 a.m. today. We'll hear from the former President Donald Trump.
Looking forward to those polls as they come in over the next few days and weeks. Let's turn to a big mover in the pre-market. Shares of Dow falling and they're down hard. The company reporting its first revenue increase since 2022, but it wasn't enough to impress investors. Dow facing lofty expectations for its AI server business, with the stock soaring 122% so far this year before this move.
Okay, so on one hand, 122%, and then you drop 16%. It looks a little bit less significant in terms of the scope of the drop. But to me, the fact that they beat expectations, that they did talk about a 30% quarter-over-quarter increase in some of their new AI-equipped servers, to me, that wasn't enough highlights this question, which is really big, that looms over the entire market. How much have people kind of gotten over their skis with the non-NVIDIA rest of the world basically being able to adopt AI as quickly as people previously priced in. NVIDIA's winning. They're making bank.
Yep.
They're consolidating this. But it's NVIDIA's win. It's not necessarily everybody else's win. And I think that that's what we keep learning.
Lots of hopes and dreams for this company. That company is down by about 15%. Just getting confirmation. We are going to Jackson Hole.
Okay.
Okay.
All right.
Well,
I'm
TK's
not.
coming too. You're not. You're at the DNC.
Yeah.
Okay. Good to know. That's the schedule for August. We don't need to know that now, do we? Okay. But we are going to go. All right.
Okay,
Tom's
thanks.
watching. All right. Let's turn to this story. Boeing will remain under close scrutiny from aviation regulators after sharing a detailed plan to address quality breakdowns at its factories. The plan is based around 6 measures, including employee skill and the number of hours worked, spend addressing defects during final assembly. This story's gone nowhere, isn't it?
That's exactly how I feel. What's there new about this? They haven't figured it out. So we're all left wondering when they're going to figure it out. And in the meantime, there's a question of whether there's going to be a backlog of planes and whether we end up with people saying, look, if you don't want your planes, I'll buy it at a discount. I mean, it's just sort of this disconnect between what the practical implications are for some of these airlines that are waiting for the deliveries and the reality on the ground, which is we still don't have answers as to what went wrong.
Let's get to some of those airlines right now. Some of them struggling this week after American slashed its outlook for the second quarter. The revision dragging down the broader industry heading into a busy summer. I'm pleased to say that Bloomberg's Guy Johnson is joined by Delta Airlines CEO Ed Bastian in Dubai. Guy Johnson, over to you.
John Farrow, thank you very much indeed. Yep, Ed Bastian here in Dubai. Tonight he's going to receive the ATW 2024 Airline of the Year award. That's why he's here. He's also here as well for the 80th IATA AGM, which is going to be taking place here at the start of next week. But John, you bring up a couple of stories, actually. You bring up what's happening with Boeing, but you also bring up the issue that we had earlier on in the week with the American numbers and the impact that that had on the rest of the sector. Ed, great to see you. Congratulations on the award, first of all.
Well, thank you, Guy. It's good to be with you. It's good to be in Dubai and really proud of our team.
Yep.
Their ability to continue delivering outstanding results for our customers is what makes these awards, first of all, very humbling to receive, but hungry to continue to win them.
Yep, you got to keep it up, don't you?
You got to keep it up.
Let's talk a little bit about kind of what is happening in the market right now and those customers that you talk about. We did see the American downgrade in terms of its guidance a few days back. I'm not going to ask you to comment on what is happening over at American, but really just to kind of get a comment on whether you're comfortable with your current guidance.
Yeah, the demand has been really strong. I think that was the issue, that with the American numbers and the quarter, as we've indicated all along these last several years, that consumer demand and that priority to invest in experiences continues to be really, really healthy. June for us is always the largest travel month of the year, of the calendar. So we still have to see how June's going to go, but I'm confident it'll be a good result for the full quarter, and we'll see how June runs out.
Are you seeing any evidence that inflation, and it's inflation day, we're going to be watching those numbers, that inflation is starting maybe to hit the middle-class traveller, that the middle-class traveller is beginning to rethink maybe the attitude towards travel, which has been really strong over the last few years?
I don't see it. Our consumer tends to be at the upper end of the income scale. Our traveler tends to go internationally. Our consumer is prioritizing travel above things. So while you may be hearing from a number of industrial sectors, trade downs occurring, we're not seeing that in our numbers.
Do you think you will see that at some point? Do we go to a more normal? Is this the new normal in terms of what travel is going to look like? Will this continue to persist? The stock market continues to do very well. We're obviously seeing an upper-end consumer that is still fairly flush with cash. Is that something that lasts years?
I think it's going to continue for quite a few years to come. One of the factors people don't give enough consideration to is our industry's capacity is lower than it's been, given the constraints around OEMs, whether it's Boeing or engine issues. So our economy is a lot larger than we were historically, go back pre-pandemic, yet the amount of capacity that we're all able to fly is significantly constrained. And that's what's keeping demand as well as pricing pretty strong.
Okay, pricing. So fares are still fairly robust, are they?
Yeah. Fares on balance are about 20% higher than they were pre-pandemic.
You bring up business travel as well. Is that something that it has come back? It's maybe come back significantly more slowly than we've seen in terms of the retail story. But is that coming back? And ultimately, given that bigger economy, is that a bigger number some way down the road?
Well, business travel this year, particularly in 2024, has really stepped up. As we went through the return from the pandemic in 22 and 23, business travelers were still a bit sluggish. largely because they weren't back in their offices. And they were still working from various remote locations. Once companies have finally laid the edict down, you needed to get back. And particularly as some of those businesses started getting a little challenged themselves, people wanted to be back in the office. That opened up the need to travel for consultancies to go visit clients, for people to get back out on the road to see their own people. So we've seen we saw about a 10-point increase in business travel at the start of the year, and that's continuing to climb.
Middle of the top line, okay, so we talked about that. That's looking good. Middle, what's happening in the middle of the P&L? Are you still seeing, what kind of inflation are you seeing in the business?
We're seeing inflation, but it's starting to moderate a bit. For us, the biggest part of our inflation story is wages, is our people, which that's the best type of inflation we can have, and our people continue to grow wages in the 4 to 5% per annum rate. We're continuing to work on productivity and efficiency so we can take some of those rates and make certain that they're productive increases. Other parts of the supply chain, where the supply chain's still not where it needs to be. We talked about the engine issues. We still don't.
How much is that holding you back?
Well, it's significantly. Again, it's not just Delta, it's the industry. And the turn times are longer. You now have turn times on planes that could extend up to months rather than weeks, which they should be. Parts are higher than ever. Material costs are growing. The manufacturers across the industry are having challenges.
This doesn't sound like an economy that you're describing that needs rate cuts right now.
Well, it's an economy right now, from my standpoint, that's doing well. But there's not just one consumer out there. Right? Our consumer, again, tends to be in the upper end. Our consumer generated a tremendous amount of wealth and continues to have that wealth through the pandemic. The market's up, real estate's up, unemployment is extraordinarily low.
They don't need more help, is basically what you're saying.
The lower end, I think there's some challenges. So that's something that the Fed will look at all the data. I don't think an airline is necessarily the indicator.
You've got a pretty good view of what's happening in the economy.
Our business is doing quite well.
Okay. You bring up Boeing. You talk about what's happening with the OEMs, Boeing and Airbus, but it's also the engines, as you mentioned, the Pratt & Whitney engine issues that we've been seeing. How long does this last? How much of a struggle is it to get hold of the kit that you need right now? How long do you think the problems that we're seeing at Boeing and Airbus and Pratt & Whitney are going to be lasting for?
Well, right now we have no Boeing orders that we're anticipating delivery on in the next several years. So from our standpoint, it's really an Airbus story. Airbus has been a great partner, and Airbus continues to provide us the planes and the technology that we've been expecting for them, and they were right through the pandemic. The engines are going to be a bigger issue, particularly for us, the geared turbofan. That's slowing down a little bit about the amount of new deliveries that we can take, but it's more engines than it is planes. And what it's causing us to do is maintain the existing fleet we have a little bit longer, so that's another cost to the business.
You are well known for keeping your fleet for longer. It had the age of the average aircraft has come down a little bit over the last few years. But does that strategy work in an environment where the sustainability question comes in? If you fly older planes, they inherently tend to be less efficient. Is that a problem that you're going to come across at some point?
I don't think so. Again, I think this is transitory. I think the OEMs will get their parts. I think they will get the transition. Again, a lot of this is about labor and the fact that many of the engine, not just the tier 1, but down into the tier 3 and tier 4 of the supply chain, let a lot of people go. So it's experience, it's staffing, it's rates. I mean, it's a very complex story. But long term, I feel good about our sustainability story. We're taking our overall footprint down in the range of 1 to 2% per year, every year, and that's going to continue to go on. And as we get new planes, those numbers are going to go down faster.
Politics is going to become a bigger and bigger issue over the next few weeks and months as we approach November. When you think about who goes next to the White House, what does the next administration need to do to keep the aviation market that you've just described, this buoyant market, this market with momentum, keep it going? What do you need to see from the next administration to keep it on track?
Most important thing is infrastructure investment. Maintaining the current structure is challenging, and they need to continue to modernize the technologies. They continue to need to get air traffic controllers staffed and hired and in position to enable us to grow. And from an investment standpoint, that's where we're very happy to see the FAA reauthorization bill finally come about. It took, unfortunately, months, if not a year overdue in its delivery, but it's here now, and we're going to work closely with the FAA to make that happen.
Just to wrap the conversation up, You feel like you are on the front foot at the moment. This is an airline that is growing. What is the capacity constraint that you are seeing right now that is going to slow your rate of growth down? If I'm an investor looking at Delta, is this as good as it gets, or does it get better from here?
We're doing well on capacity growth. This year, we expect to grow our top line in the mid single digits, in that 4 to 6, 7% range, which I think is healthy growth, considering particularly the growth we've had over these last handful of years. This year will be the highest revenues in our company's history, order $60 billion plus or minus. And the outlook, I think, is strong because I think the supply chain and the constraints are only going to get a little bit better as we move forward.
Ed, congratulations on the award, the ATW award that you'll be getting here in Dubai this evening. Great to see you here in Dubai.
Great to see you.
Thanks for stopping by to see us here.
Thanks, Guy.
At Bloomberg.
Great to be with you.
Thank you very much. John, from Dubai, back to you.
Thank you, buddy. Great to catch up and hear that conversation. Guy Johnson there with the Delta Airlines CEO, Ed Bastian. That stock just turning positive in the pre-market. Two big takeaways. I'm paraphrasing here. We're not American Airlines. One. Two, we have a more affluent traveller and we're not seeing trade down. We're not losing business. Two big takeaways in that conversation.
And frankly, this is actually why American Airlines was penalized. That Delta and United, but Delta more particularly, is doing a better job monetizing some of their clients and catering to higher end, particularly business class travelers that pack the lounges.
Yeah, this is how we started the week. Is it an American Airlines problem? Or an airline's problem, and we're finding out from the other airlines it's the former, it's not the latter. Equity futures right now on the S&P, negative by 0.2%. Up next on the programme, diverging Fed speak.
Looking at this broader context, the behavior of the economy over the past year provides ample evidence that monetary policy is restrictive in a way that helps achieve our goals.
That conversation just around the corner. Bramo disappointed we didn't get questions about the lounge and what's happening at Terminal 4 and what they can do about it.
You spend too much time at airports.
Too much time in Terminal 4.
All right, we can discuss this later.
Futures negative. This is Bloomberg. Bob Michael in the studio. First thing he says, what are you doing here? It's Friday. I didn't know that was a thing. You don't have to be here on Friday.
Please sign me up. If you weren't here, who would say, let's get us to the weekend?
I would agree. It's a duty that I've got to come and fulfill. That's why I'm here. Let's get you to that weekend. Equity futures on the S&P, negative by 0.2%. Yields unchanged on a 10-year, 455.21. Under surveillance this morning, sufficiently restrictive.
Looking at this broader context, the behavior of the economy over the past year provides ample evidence that monetary policy is restrictive in a way that helps achieve our goals. We're seeing clear and consistent signs that the imbalances between supply and demand in the economy are receding, and we've seen a broad-based decline in inflation.
So the current New York Fed president thinks we are sufficiently restrictive. The former New York Fed president is asking whether we actually are or not. And he's got some company on the FOMC in the Dallas Fed president, Lori Logan. Bob Michael of JPMorgan Asset Management writing this: a soft landing continues to unfold and should allow the Fed to cut rates in September and December. Bob is with us around the table. Bob, good morning to you.
Good morning.
Are we sufficiently restrictive or not?
100%, absolutely, we are sufficiently restrictive.
So Williams over Dudley?
100%.
What tells you?
Well, this is the highest Fed funds rate since the 6.5% of 2000, when we were in the midst of the dot-com bubble. And even then, 6.5% was plenty strong enough to slow things down. So I think 5.25%, 5.5% is plenty strong. We're going to get core personal consumption expenditures in about 40 minutes or so. That should come in year over year around 2.7, 2.8. That's half of where it was a couple years ago. So things have slowed down a lot. You've got a very high real Fed funds rate. You look at the bottom half of businesses and households, they're slowing down. Don't listen to me, listen to Brian Moynihan, who was out yesterday saying, oh, goodness me, look at the slowdown that's occurring there.
How relevant do you think payrolls is next Friday? A week today, in about 40 minutes' time, we'll get that number. How relevant is that number?
I think the personal consumption expenditures number is very important, just so that we know the disinflationary trend is underway. We're not going to get that close to the 2% target, but we'll confirm that we're on that path. That's good enough. For the Fed to think about moving earlier, they're going to have to see more stress in the labor market. They're going to have to see unemployment start to go higher meaningfully. Think 4.2, 4.3%. We're a little bit away from that now, but that could change over the next few months.
Okay. You said, yes, definitely sufficiently restrictive. So then why haven't we seen more of a slowdown as of yet? Why have we been surprised consistently by how hot inflation has come in and, frankly, how strong growth is?
Because there's a lot of money still sloshing around in the system from all the fiscal transfers that have occurred during the pandemic. And that just takes time to work its way through. But it is. And you are seeing the pressure on the bottom half of income earners. They're putting more on credit. They're cutting back purchases across the board. Maybe they're still trying to get in a bit more of spending on services, travel and leisure in particular. That probably starts to slow down over the summer. There is sticker shock in prices. And you are seeing the stress in businesses. When you look at small and middle market corporate America, that's where the amend and extend is occurring. That's where they are cutting back on CapEx.
Can two things be true at the same time? We all kind of agree that there has been a real weakness, particularly in the middle and lower income consumer. We see this with the small caps, that there definitely is stress there. But then we have people saying, even with that, if you cut rates now, you add to that money that's sloshing around. We saw M2, the amount of money in the system, actually increase for the first time in a couple years in the past quarter. If you cut rates now, you're going to turbocharge inflation next year, potentially, especially if there are certain kinds of fiscal policies put into place.
It depends how far and how quickly you cut rates. If you do what the Fed did in 1995, and I believe Fed Chair Powell is well aware of what they did, they just took the edge off of businesses and households. They had hiked rates from 3% to 6% in a year, and then they cut rates 25 basis points and then 50 basis points. That was enough to ensure a soft landing. I think that's what Fed Chair Powell is playing for. He wants to ensure that they just take the edge off of businesses and households, not reignite stuff. And I think his concern is if they don't do something soon, then the long and variable lags will start to catch up in a much bigger way. And the pressure that you're seeing on the lower half of businesses and households will continue to spread above the line into the top half.
Bob, how much cash is on the sidelines and where does it go?
There's a massive amount of cash on the sidelines. I'm surprised Lisa didn't ask me about all the Treasury issuance and what that did to the market.
Well, this is sort of the tee up for that.
Yes, thank you very much for that.
I like to be unpredictable.
I love that everyone talks about, oh, you can't touch the bond market here. Look at all the supply. I get loads of questions from clients. We're trading 100 basis points through the Fed funds rate. It's not like the Treasury curve is at 5.5%, 6% and heading north to 7%. So there's a lot of buying that's going on and willing to accept yields below cash. But we see three vast pools of money out there that are waiting for the yield curve to disinvert because right now they're comfortable in cash. The first are wealth management platforms. When I meet with clients of a private bank, they're comfortable in cash. They're getting 5.5%. Why do they need to go out on the curve? Sure, some money's leaked into the market, but when you look at the $6 trillion sitting there in cash, that's a lot of money that could still yet come into the market. And by the way, they've had the right trade to sit in cash for the last couple of years. When the Fed starts cutting rates, that comes in. That's the first pool. The second pool is banks. Banks are far better off keeping money in overnight reverse repo at 540, 545 than going out into the mortgage market, buying a combination of Ginnie 5.5s, 5.5s, Ginnie 6s, you've got that 575 blended coupon. You're only 30 or so basis points above overnight reverse repo, and you have all that negative convexity. Why on earth do you do that for a handful of basis points? So they're not doing it. And the last one, I was in Tokyo a couple weeks ago. I know you poo-pooed that because everyone goes to Tokyo, but you learn a lot being there in the ground.
I didn't say anything.
Listen, your producer told me there would be no hard questions on Friday mornings, and you guys have just fired 3 off.
One.
You fired 3 off. But it's foreign buyers. If you talk to the big Japanese historic investors in the bond market. They're saying, hey, the cost of hedging back to yen is 5.5%. And that's not your hurdle rate. 6.5% is your hurdle rate because we could put money in JGBs at 1%. When the yield curve starts to disinvert and retains the normal shape, that's the third pool of money that comes into the market. I think all of that money is in play from September on.
Got it. Very defensive this morning. Bob Michael of JPMorgan, disappointed I'm here apparently. Bob, thank you. Appreciate it. It wasn't about the auction, it's about the inverted curve. Did you get that?
Yeah, I got that.
Okay.
Fully
Good.
understood that.
It's
And
not
the pools
about
of
supply.
money.
Yes. Ready to be deployed.
Yeah.
When that curve starts to disinvert.
So sub 3%.
The Fed starts to cut.
I said we're going to start to see everything kind of go down.
Sort of re-steepen and people want to buy it.
Mm-hmm.
Okay.
Okay.
Good stuff. Bob, thank you.
Always a pleasure to be here.
Thank you, sir. I hope. Ed Yardeni of Yardeni Research joins us next. Bloomberg's Woo Jin Ho, Lara Rhame of SF Investments, and SocGen's Subadra Rajappa. Your PCE data 34 minutes away from New York City. This is Bloomberg.
It's not unreasonable to worry about inflation.
We are seeing inflation come down. I think that when we look at the next couple of quarters, we'll probably see some ebb and flow.
We're kind of optimistic about inflation in the near term.
To get to that July cut, you would need probably some combination of soft enough labor market data and enough decline in the run rate for inflation.
The Fed's not going to be cutting rates because inflation is magically back down to target. They're going to be cutting rates because all of a sudden they have to start worrying about the labor market.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The next 60 minutes absolutely dedicated to financial markets. Live from New York City this morning. Good morning, good morning. The third hour of Bloomberg Surveillance begins right now. Equity futures are raising this morning's losses, down by about 0.1% on the S&P 500. Down on the session, just off on the week. After 5 weeks without losses on the S&P, we are still up on the month for the month of May on the S&P 500 and on the Nasdaq too. The next 60 minutes looks like this. 30 minutes from now, we will get PCE data in America. That is the last big data point before the Fed goes quiet. That's the good news. No Fed speak for the next week, going into the Federal Reserve meeting. Rhame, 2 Wednesdays away.
What I'm curious is how big is the market reaction going to be to what we get in about 30 minutes time? This idea of if we get a downside surprise on the key metric that the Fed looks at in order to get a sense of inflation, do we see suddenly the idea of a July rate cut cutting back on the table? I mean, how aggressive could you see, given all of the moves that we've seen recently, to even peripheral data points?
There's a really strong argument to make this morning that what happens with prices this year is far more important to the outcome of November than what happened yesterday afternoon. Is that fair?
That is fair. When you look at the polling, the economy, and notably inflation continue to be top of mind of the American voters. And in our polling, what we've continuously see is that there is a trust deficit between the electorate and Biden when it comes to handling the economy. And a lot of individuals think that Trump would actually do a better job. When it comes to this conviction going into it, the electorate, it was muddy waters. Very mixed picture on whether or not this is going to change the outcome on how people vote.
Looking for more polling over the next week or so. I want to pick out a single name as we get closer towards the opening bell at about 90 minutes time. I want to look at Dow. Dow is down in the pre-market by 16%. And when you look at a move like this following earnings, you probably think that's a big miss. Big downside surprise on Dow earnings. Lisa, there wasn't. We're down by 17% because a beat isn't big enough in this market.
Okay, sales increased 6.3% to $22.2 billion. The estimate was $21.6 billion. This should be something that is rewarded. I guess the question is how many of the rewards have already been baked in, not just to Dell, but to other companies as well. And we've been talking about this throughout the show, and I think that it's a fair question, especially during some of the spotty and violent trading that we're seeing ahead of the market open. How much have we overpriced how quickly we can bring artificial intelligence to all these different sectors and create this incredible productivity wave at a time where we're still facing some really real pressures in terms of inflation, in terms of a weakening lower end consumer.
We've had some great conversations in the last month or so. I'm just reminded as you speak of Jack Caffrey of JPMorgan. And Jack pointed out that maybe he thinks that some of these trades look a little bit stretched. The fact that we started to pile into second derivative AI trades like utilities, which have had a pretty stellar month in the month of May.
Peter Tchir was speaking speaking about that as well. But honestly, what he was speaking about, Jack, was saying, listen, people are looking at utilities, the permitting, how quickly they can get this off the ground, building it out. We were speaking with the CEO of Baker Hughes, and he was saying, yes, the electricity demand is going to be incredible, but right now it's acting as a vice on the potential percolation of artificial intelligence through the industry because there just isn't enough energy to supply some of the projections that people have on the other side.
And is there enough in the commodity space to support this? This is why Jeff Curry says copper is basically the best trade he's seen in his entire lifetime.
Speaking of punishment and big single name moves, I want to reflect on American from earlier this week. American Airlines down after cutting their outlook. The others didn't do the same thing. United affirmed their outlook. We caught up with Delta, the CEO, Ed Bastian, Guy Johnson in Dubai about 30 minutes ago. If you missed that, just the basic highlights for you. We're not American Airlines. We're still pretty constructive on the summer ahead of us. Yes, we have a more affluent consumer, but we're not seeing the trade down that maybe you're seeing at other organizations. They're not seeing that at all. That stock's going to be okay.
Which is the reason why people are saying it is an execution issue over at American Airlines. The other thing that Ed Bastian said was that business travel has really stepped up. How many people who have come on this set, every single one of them, I've been traveling so much.
Bob Michael, Japan.
To Tokyo. But everywhere.
Dollar yen 160.
Thank you. You can carry on with
Everyone's going to
currencies.
Tokyo.
I know. Well, there's a reason for it. You think it's just because they've got good buying power with the currencies?
Dollar yen 160.
I think
that's the tourism. I know where the bond managers are going there. There's some income where there wasn't income before.
Correct.
They want to talk to Japanese investors about what they're doing now. I get that.
And suddenly the economy is doing well. But you're right. People are going there just like they're going to the south of Europe because of where the euro is.
Euro dollar sub 110, we'll take that. Dollar yen 160, we'll take that. You know, sort of a US bias here, but yes, we'll take it. Equities right now in the S&P down by about a tenth of 1%. The opening bell in about 1 hour and 25 minutes. In the bond market, yields just about unchanged on a 10-year 455.21. Coming up this hour, we'll catch up with Ed Yardeni of Yardeni Research on lofty expectations for the Magnificent Seven, Woo Jin Ho of Bloomberg Intelligence on Dow's mixed earnings report, and Lara Rhame with PCE data about 30 minutes away. We begin with the big issue, heading towards a week of losses going into this morning's inflation data. Ed Yardeni of Yardeni Research weighing in writing this. If investors get a whiff that the lofty growth expectations for secular AI spending need to be lowered, they'll inflict swift punishment. Two S&P 500 sectors specifically would bear the brunt of the resultant price declines: information technology and communication services. Ed is with us now for more. Ed, do you think this move in Dow this morning speaks to exactly what you're flagging?
Yeah, I didn't expect that view I had would be validated so quickly. But I think it was also Salesforce. I think suddenly there's a recognition that all those revenues that NVIDIA's accumulating and likely to accumulate come from increased capital spending by every other technology company in the world. And initially, that's going to be a burden on profitability, and there's not going to be an immediate payoff in artificial intelligence increasing productivity.
Ed, does that make you bearish at the single name level across some of these big names or on the broader market?
Well, I think it's actually a healthy development that the market is starting to recognize a more balanced view of what's going on in technology and the economy in general. I think what the market's recognizing is that it's not going to be straight up in artificial intelligence, and it's going to take a while, and it's going to be expensive. And by the way, so far, we know that artificial intelligence is artificial. We're not quite sure if it's that intelligent just yet. It does make a lot of mistakes, so there's a lot of work to be done to still perfect it. So put it all together, and yes, I think it validates our view that the market, we're still in a bull market, but it's going to be slowing down from here. We're looking for 5,400 by year end. A few days ago, people were asking me, why aren't I raising my numbers? But now I feel comfortable that I didn't.
But there is this larger argument, and I think it's fascinating that you're making this case because you have been bullish, but with the tempered reality of how quickly we can go to some of these technological advancements. There is a sort of a tag on here about implications for productivity and some of the broader economic gains that come with AI adoption. If it's going to take a lot longer than we've currently baked in, well, doesn't that mean that some of our expectations of increased productivity, bringing inflation down, and some of the ballasts to the economic growth maybe not being as strong as they previously were assumed to be?
Well, I've been a bull on productivity for a while. I've been talking about the roaring 2020s based on the idea that there's a shortage of labor and companies are going to figure out ways to increase productivity. And I base that not on AI. I said there's enough technologies out there already that can increase the productivity of labor. And sure enough, last year it was a great year for productivity. It was over 2%, which is quite a strong move. And I think that's going to continue to be the case. So I think if we recognize that artificial intelligence is just part of that productivity puzzle, we'll have a more realistic view of what that technology can deliver.
And I know that you've also been saying that this is not an economy that needs rate cuts, and that if you do get rate cuts, you turbocharge potential inflation, as well as some of the stock market moves that we've seen already. Right. I want to tie that to this idea of some of the pitfalls that we're seeing in specific names in technology. If the Fed were to cut rates, if we do see some sort of slowdown in inflation, and the Fed cuts rates, do you see some of these losses on these names actually retraced pretty quickly as people say, okay, well, it's cheaper for us to sort of bet on future growth at a time of potentially lower yields?
Well, I think that if the market starts to get a whiff of the possibility that the Fed put is back, then that scenario you just laid out could certainly play out very quickly. We were only a few days ago, maybe a couple of weeks ago, I had concerns about a melt-up, and now I'm less concerned about that because the market is getting more realistic about what technology can deliver. But yes, I don't think the economy needs rate cuts. I think rates are, sure, the Fed is tightened, but the reality is they've normalized. Interest rates are back to where they were before the great financial crisis. The economy was resilient back then. I think the economy is proving itself to be resilient right now.
But Ed, are you Team Williams or Dudley in terms of sufficiently restrictive in terms of the economy?
Well, my own view is simply that these levels of interest rates, they're kind of where they should be. The Fed officials, Dudley and Williams, Dudley used to be a Fed official, but these folks still talk about R-star, this ideal level of interest rates at which you get an economy that's growing reasonably well with an unemployment rate that's quite low, with inflation coming down. Well, folks, that's where we are right now. We're in that nirvana situation, so why mess with success?
Ed, you are Mr. Bond Vigilante. I'd love to talk to you about that just a little bit. Sure. Had a bit of pushback from some of the auctions this week. I think we had about $183 billion worth across 3 tenors, a 2-year, 5-year, 7-year. Just wondering what you made of that this week.
Well, certainly it was an immediate wake-up call on the supply-demand issue. We had that issue back last year during August, September, and October, when the bond yield soared from 4.25% to 5% just in a very short period of time. And suddenly there was a recognition once again that the deficit really could be a serious problem and create a debt crisis. So I think we want to be aware of that. But I attribute this small backup in the bond yield, but not so much to the auctions as to a realization that the Fed really is in no rush to lower interest rates and that short-term rates could stay here for a while. Neil Kashkarian gave us that kind of new Fed playbook that he said that he wants to see the inflation rate stay low for several months. So even if we get a good reading here at 8:30, that doesn't mean the Fed's suddenly going to be in easing mode. I think Kashkarian's view is the Fed view that we need several months of inflation at our 2% level, and we're not there yet, clearly.
Ed, given the lack of visibility around 25, I just wonder what your best guess is now. Is it no cuts in 24?
Well, it's no cuts this year. That's still my view. At the beginning of the year, people were talking about 6, 7. I thought, well, 2, 3, and I was kind of, I still didn't understand why even there would be 2, 3, but I figured maybe I was missing something. But along the way, everybody's kind of come to the conclusion that maybe it's 1, 2, while I'm at 0 and a few others are at 0 rate cuts this year.
You've got company in Apollo's Thorsten Slok, that's for sure. Ed, thank you, sir, for this morning. Appreciate it. Ed Yardeni there of Yardeni Research. The Bob Michael explanation from JPMorgan, if you missed that, by the way, was with us about 15 minutes ago. I thought it was interesting. 3 pools of cash that at the moment don't want to go out along the curve because they don't need to. They can sit in money market funds and get paid, ultimately, 5%, more than that. Why would you go out along the curve, take an additional 10 years, go out to a 10-year for 100 basis points less. Why bother?
Basically, as soon as there's a normalization of the yield curve and you've got long end yields that are actually yielding more than short end yields, then all of a sudden these pools of cash will get unleashed and trillions of dollars, will come in. I guess then the question is, what will it take to actually normalize the curve? How many rate cuts, and is that feasible? And if not, do you see normalization on the other end, which is basically long end yields going a significantly degree higher?
It's the bull steepener that everyone was looking for coming into 2024 and just got pushed out pretty quickly. Equity futures on the S&P 500 down here by about 0.1%. Let's get you up to speed on some news elsewhere with your Bloomberg Brief. It's Danny Berger. Hey, Danny.
Hey, John. Torrential rainfall in Brazil has led to catastrophic flooding in the country's southernmost state. At least 160 people have been killed and 600,000 have been displaced. It's the third major flood to hit the region in just the last year. Local mayors are weighing the idea of relocating entire neighborhoods away from high-risk areas. Officials say it's still impossible to estimate how many areas will have to move their residents because the rainfall is still ongoing. Donald Trump was found guilty on 34 counts of falsifying business records to conceal hush money payments to an adult film star. Prosecutors argued that it was a conspiracy theory that deprived voters of vital information ahead of the 2016 election. Trump now faces as many as 4 years in prison when he is sentenced on July 11th. That's just 4 days before the start of the Republican National Convention. Boeing and U.S. aviation safety regulators will track 6 measures to judge the health of the company's production system. Indicators will include the number of hours spent repairing the aircraft during final assembly, employee skill and proficiency, and daily shortages of parts from suppliers. U.S. regulators vowed to maintain tougher scrutiny of the plane maker. And that's your brief. John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the programme, we'll get you some morning calls, plus Woo Jin Ho of Bloomberg Intelligence on Dow's missed AI expectations. That conversation just around the corner from New York. This is Bloomberg. Big economic data point about 12 minutes away, waiting for PCE data in America, the Fed's preferred gauge of inflation. Equity futures on the S&P 500 going into that print, negative by just 0.1%. Let's get you some morning calls. First up, Morgan Stanley raising its price target on Gap to 27. The analyst highlighting stronger than expected results across its brand portfolio, but noting an expensive valuation. The stock is up 22%. Next up, Mizuho raising its price target on Micron to 155. Analyst Vijay Rakesh saying the chip maker is well positioned as demand for AI smartphones and PCs is expected to increase. And finally, Barclays lowering its price target on Dell to 97. The analyst citing a miss on AI server expectations given the run-up in the stock, expecting more disappointing results in the future. Dow shares down by 16% this morning. Let's catch up with Woo Jin Ho of Bloomberg Intelligence, who joins us now for more. Woo, can we just start with those numbers yesterday? Where was the grand disappointment for this market, given that we've got a single name down here by 15, 16, 17 percentage points all morning?
Hey, John. So there's a couple of areas of disappointment for Dell. It was probably the backlog number. First of all, the backlog numbers came in at 3.8 billion. I think the whisper numbers were much higher, especially given where the valuations were at the time. And then the second is the AI server profitability. It's probably going to be more earnings neutral versus a more typical 9 to 10% server profitability. So, you're not getting any return on your AI server numbers.
Well, Jim, can we just finish on that point? I think that's so important. Just elaborate a little bit more on that. That came up on the call. I think it was Tony Sacconaghi who asked the question about the margins on these servers. Are we saying that where they're going to get the best revenue growth in the future is from a product that dilutes margins?
And that was a brilliant question by Tony, quite frankly. And look, we have to keep in mind that we're still in the early days of the AI server boom, or the AI infrastructure build-out boom. And what Dell is coming up against is trying to gain footprint, and the best way to get early footprint is pricing. If we listen to Supermicro's earnings call about a month back, essentially what they said was that their margins were going to be a little bit dilutive from competitive pressure. There are a lot of deals that are out there, and the first to win those deals could probably have a long runway to win more server deals in the future.
Woo-Jin, we've been spending the morning wondering whether Dell is sort of indicative of a broader over-enthusiasm of where AI is taking non-NVIDIA companies. I don't know how else to characterize them, but they seem to be the global winner in all of this. Do you think that's right, or do you think that this is a Dell-specific story and how they're trying to win market share, and what sort of services and hardware they're providing?
Sure. So I want to take that question in a couple of ways, Lisa. If we look at Dell's forecast, what I back into is about an $8 billion annual revenue in AI servers. Roughly $2.2 billion of it is coming in next quarter. They already booked 1.7 or recognized 1.7 this past quarter. That revenue is flattening out in the second half of this year. Given that there is this huge pipeline of deals that Dell keeps on talking about, the gatekeeper of those deals is still NVIDIA because they still hold those valuable chips, right? And depending on where NVIDIA want to send those chips, the vendor wins. Now, the second aspect of it is valuation. Prior to the print, they were trading roughly around 21 times forward earnings. This, at the end of the day, it's a hardware company. Before this AI frenzy, hardware names were trading around 7 to 9 times. So you're getting a 10-point premium just for the AI alone.
Woo-Jin, this was great. It's good to hear from you, sir. Thank you. Woo-Jin Ho there of Bloomberg Intelligence. That name's down hard this morning. It was Morgan Stanley's Mike Wilson, I think, who said AI is everywhere except in the numbers. And of course, he was talking a little bit loosely about the broader equity market, but this is an example of that, isn't it? It's just not in the profits just yet.
If you strip NVIDIA out, it isn't in the profits. And what I find fascinating, and Woo-Jin really highlighted this, is that NVIDIA holds all the cards, or all the chips, as you may, in terms of what they decide to charge, who they decide to ship it to, and it's their profits, not necessarily everybody else's.
Big move lower for that stock this morning. NVIDIA still positive in the pre-market. The broader equity market, about 1 hour and 8 minutes away from that opening bell, erasing this morning's losses, still lower by about 0.1% on the S&P. PCE data is just around the corner. Bloomberg's Michael McKee with us in the studio, ready to break that down. Mike, what should we be all looking for in about 7 minutes?
Well, the one thing economists think is going to happen is that core will come in on a slightly lower basis for the month of April. And while that really won't affect the year-over-year trajectory, it will reignite the idea that inflation's going down and that the Fed can at least start thinking about cuts. We've heard over the last, 72 hours or so, a lot of people at the Fed saying higher for longer, just going to stay where we are. And I don't think this number is going to change that, certainly not in the short run.
You know, it's sort of this compelling theory about whether Neel Kashkari kind of speaks for the committee in saying that now the threshold is a couple of months of data that cooperate. Is that really sort of a more mainstream view? Or if we get a real downside surprise in this particular print, could that alone really increase the likelihood of, say, even a July rate cut?
No, I mean, it would change some thinking on Wall Street, but it wouldn't affect the way the Fed is thinking. Chris Waller has said the same thing as Neel Kashkari. They've all kind of said the same thing. We need a couple months to make sure that it's still going down, because if you got a big drop, that could have been some sort of one-off that then reverses the next month, and you don't want to be in a position to make a decision that you then have to reverse. So they're going to wait. The real debate now seems to be, are we tight enough? Because Lori Logan said last night, we may not be. She joins that camp. And then the question becomes, do you need to raise rates, or do you just need to leave them where they are for longer? And I think the majority of the committee is leave them where they are. And if you get any kind of numbers like we're expecting today, you can do that.
If we weren't here and you had Bill Dudley here and John Williams over there, and you had a nice little round table this morning going into this data, what would you ask them? What would you say?
Well, I guess you could ask what Bill sees as the reasons for why R-star, the neutral rate, is higher and whether they will be sustained. Because the second part of the question is not is it higher, but does that last? Or is this a temporary thing because of various things in the economy that you don't want to overreact to? So that would kind of be the issue. John Williams, obviously, you can ask him what R-star is, since he's the guy that invented the index.
Exactly.
But it hasn't worked, basically, since the pandemic.
It's the round table we all want right now, right? Williams, Dudley, let's figure this out.
Just introduce them and let them hash it out.
Just let them go. They're very polite individuals.
You and him fight.
I don't think those two are going to fight, but, you know, we'll try and make something
Intellectual.
happen. An intellectual battle.
Correct.
So
Yeah.
sophisticated here at Bloomberg, aren't we? PCE data coming up next. Equity futures down just a little bit from New York. This is Bloomberg. Inflation data moments away, just about 20 seconds away or so. Here are the scores going into it. The opening bell about 60 minutes away. Equity futures on the S&P negative by 0.06%. On the Nasdaq, we're down about 0.2. Quick snapshot of the scores in the bond market for you on a 2-year and a 10-year. The 2-year at the moment, 493.52. On a 10-year, we're at 454.61. With that inflation data, the PCE deflator, here's Mike McKee. Mike, what have we got?
Well, you've got the income and spending numbers have dropped, although we're waiting for the deflators. But 0.2 gain in personal spending, lower than the 0.3 forecast, and certainly down from 0.8 in the prior month. The personal income number is 0.3, exactly as forecast, but also down from 0.5. We want to break that down because we have had some movement in incomes that you never know whether it's wages and salaries or what else. All right, so now we have the inflation numbers. The deflator, the PCE headline comes in up 0.3 as forecast, puts us at 2.7% year over year as forecast, and that's what it was last month. And we do get the 0.2 for the core, which leaves us at 2.8%. So we are like bang on. And I think PCE has become one of the numbers that economists just get right because they get the inputs from CPI and PPI and they put them together. And we have been on point with this for a long time.
No bad news is good news. We've said this a few times about the inflation data. A meet is a beat. And right now, equity futures at the moment are positive by about 0.13% on the S&P 500. If you turn to the bond market, quick snapshot of how things are developing there. Yields pulled back just a little bit, down a basis point or two on a 10-year at 4.53. At least on a 2-year, came really close to 5% this week. Now back down to about 4.91, 4.92.
And just sort of an interesting note, one thing that I've been waiting for is the revisions, and they came in actually also with a downward revision. So in other words, not only did personal income and personal spending come in, personal income as expected, personal spending lower. It also was revised lower in the prior month. So to me, it sort of indicates maybe the consumer is losing enough steam to give people confidence that we're on this disinflationary trend, at least on the margins. That seems to be what the market is reacting to.
The core deflator month over month coming in at 0.2. The survey 0.2. The median estimate in our survey here at Bloomberg year over year coming in at 2.8%. In our survey 2.8%. Mike McKee, we're going to the quiet period from today into next week. No more Fed speak. You get a little break. How do you think this changes things in any way, shape or form going into not next Wednesday, but the following Wednesday?
No way, shape or form does this change anything because it was what was expected. It shows that there's still progress, that the economy is slowing but not falling off a cliff, which is what's supposed to happen when the Fed raises rates. So they're going to say, we're on track. This is what we expected. It tells us that inflation is still going down, but we need to continue to see more progress because we're only at 2.8. We got to get to, 2% or maybe 2.4, 2.5. You can ask our guests in just a second what they think the starting point will be, because Jay Powell and others have said we're not going to wait till we get to 2.
I like what John says, which is a meet is the new beat. And I think that it's absolutely the correct theme, especially when it comes to inflation data. On the margins, there also is this sort of miss in the right direction in terms of personal spending, at least if people want to see cooling spending. What do you make of the fact that revisions are so frequently downward these days, that we get these data points and that they're revised, sometimes significantly, sometimes not, but usually in a downward fashion?
Well, there's an old rule proposed by Larry Meyer when he was on the Fed that if you get a surprising number, the revision is going to surprise in the same direction. And lately, that's what we've been getting in the employment numbers that just changed last month. We'll see if it continues. And so we get a little bit of this where we've seen surprisingly all of a sudden weaker growth. But it shouldn't be surprising, I guess, because that's what the Fed's been waiting for. The surprise was that it didn't happen sooner.
The surprise was Q1, and we're trying to work out whether Q1 was a head fake or not. If you are just joining us, welcome. Had PCE data about 3-4 minutes ago. This is what it looks like. The core PCE deflator comes in at 0.2% month over month, bang in line with estimates in our survey here at Bloomberg. Year over year, 2.8%. Bang in line with estimates, 2.8%. Equity futures just about positive by 0.2% on the S&P 500. Picture of bonds for you, which have been all over the place this week. Yields up a little bit on soft auctions, down a little bit on what BMO's Ian Lincoln called bond-friendly economic data. Get a bit more of that this morning, apparently. We're down about 2 basis points on a 10-year, 452.82. You got a final word, Mike?
Yeah. When we look at the income numbers, wages and salaries were only up 0.2 after a 0.6 gain in March. So wages and salary growth is slowing, which is what the Fed wants to see. They've been afraid that we would see continued upward wage pressure. And as the labor market loosens, that kind of comes off. It also suggests that you get disposable personal income up only 0.2, and on a chain basis, on an inflation-adjusted basis, it's down 0.1. So suggests spending may be weak going forward as well.
Let's get to the guest panel with futures positive, 0.25%. Lara Rhame of FS Investments is with us alongside SocGen's Subadra Rajappa. Lara, let's start with you. Your reaction to this data, you've had 5 minutes to chew over it. What stands out for you?
So, we've had now sort of 4 months of unfriendly inflation data and growth really continuing to surprise to the upside. Today's got to be a huge relief because some of the early numbers for April were really confirmed by this broader look and this broader data. So, this is a more dovish report. I feel like you have to acknowledge that. I do notice the slowdown in spending, especially the real spending. We're starting to get data for Q2, and, you teased that going into this, but we had still peeling back the headline number of Q1. The underlying data was fairly strong. I think we're now waiting to see how Q2 shapes up. So far, it looks like it's also going to be a little bit slower. I think the landing may be really sort of orchestrated in Q2.
Subadra, is that landing in sight?
We think that the Fed's going to stay on hold for the remainder of the year, and this data point doesn't really push. There's no sense of urgency, I think, from the Fed. With the inflation starting to ease up, growth is starting to come down. But we heard from Williams yesterday, and he's expecting growth in the context of 2 to 2.5% for this year. Inflation, core PCE heading towards 2.5% by the end of the year. There's really no urgency for the Fed to cut rates anytime this year. I would say the earliest I'd be looking for the Fed to cut rates is after the elections at the December meeting, if the data requires them to do so.
But Subadra, on the margins, given the fact that this isn't necessarily a game changer, but that it does confirm this idea that maybe the disinflationary trend is back on track, does that give you more conviction, actually, with some of your closely held beliefs, this idea that you should buy bonds, particularly the longer end, and that inflation will come down and that we will essentially normalize?
You can buy bonds in the long end, but it's really much more attractive to hold front-end treasuries because the yields are way more attractive. And that's exactly what you're seeing in investors. I mean, you're seeing AUMs in money market funds at $6 trillion. Money is going into the very front end of the yield curve just because returns look very, very attractive and the yield curve is inverted. And I think that trend is here to stay until we know that the Fed is going to be cutting rates aggressively. And this is really when it gets a little bit tricky for me because you look at the policy path that's priced in the markets, you're looking at, very few cuts between now and the middle of next year. So you're looking at less than 100 basis points of cuts by the middle of next year. So that still argues for investors to continue to plow money into the very front end of the yield curve, not so much in the long end.
Lara, this raises this sort of larger question, which is, does it really matter if the Fed cuts rates once, right? I mean, this is the issue that we have with the ECB as well. Are people looking for evidence of a real slowdown that could lead to a protracted rate cutting cycle? Based on what we're seeing now, does this data go anywhere near beginning to move us in that direction?
Yeah, and maybe I'll take that question in a slightly different direction because I agree, 25 basis points especially given where we are at, over 5.25, is not going to move the needle tremendously on interest rate sensitive sectors of the economy. I think the question to me is, we're probably not focused enough on growth, which has been so strong at 3%. Expectations of higher growth are now so built into markets. Nominal GDP growth of 6% turns out is enough to power equities higher, even though rate cut expectations have been ratcheted very far back. So going forward, if that slows to 5%, this isn't a big slowdown, but I think, we need to pay attention to the fact that so much growth is priced into earnings expectations, and there's so much optimism priced into markets. The two-way risk on growth numbers are now really significant. We haven't seen that in a year and a half.
Lara, before we run away with the conversation about growth, can we just sit on inflation just for one beat longer? You've been saying for a while that we'd get stuck around 3%. Are you rethinking that?
I'm not. I still think that at the end of the year, we're going to see rent inflation pressures continue to creep back up. And I think we're going to see the inflationary process really stuck around 3%. I don't think that stops the Fed from cutting if the economy slows a lot. But I think it makes it very hard to maneuver in a place where we're still growing at 2.5%.
Mohamed El-Erian's been on this program and he talks about stagflationary wins. Lara, are you thinking about stagflationary wins at the back end of this year?
Today the economy looks really solid. I'm not too worried about it because business investment is going to ratchet back up again. I think we're in a good place for the economy. I'm trying not to overthink it too much.
Subadra, are we overthinking it? When you say no rate cuts this year and you're looking at inflation, what does growth look like at the back end of 24?
Probably going to gradually slow down as we progress through the remainder of the year. We're not overthinking it. I think the simplest path is for the Fed to stay on hold for the remainder of the year instead of kind of the conundrum that the ECB is in right now where, the market's pricing in for a June cut and then the debate on whether they're going to cut again in July, whether they're going to cut again in September. So the sort of volatility of expectations is really what's confusing investors. So to me, a very straightforward path is for the Fed to stay on hold for as long as they possibly can and then embark on maybe a cut a quarter or some sort of a very stable, steady path of rate cuts from then on as opposed to this back and forth.
Lara really raised this two-pronged idea of both inflation and then this idea of growth. And what happens if you start moving out of the inflation being offset by strong growth to maybe not stagflation, but inflation not being offset as much. Subadra, does that make you, if there is clear slowing in growth, clear growing in spending, a little less sanguine about riskier securities within fixed income just because you both have rates on hold, still enough inflation to make the Fed nervous, but an economy that just doesn't have the same kind of juice in it?
Yep. Because of that, that's one of the reasons why we think that across the yield curve, yields are going to struggle to get above that 5% level. 2-year above 5% is going to require a much more different stance from policy. The Fed either has to hike or not cut for the next couple of years. And for the 10-year to get above 5%, the market is always going to be looking towards growth slowing down in the second half, and that's really going to cap the rise in yield. So even though we've had these discussions about R-star and whether R-star is a lot higher and whether debt and deficits start to matter, I really think that the focus, at least for the second half, is going to be on the slowdown in growth, and that's going to really cap the rise in yields. 10-year yields are going to struggle to get to 5% this time around.
Where are you on the R-star debate?
There's a case to be made, and I'm very sympathetic to the comments we've had from both Bill Dudley as well as Lori Logan that maybe R-star is a lot higher, at least a short-term R-star might be higher than what we're hearing from Fed President Williams. But the question is, how can the Fed actually act on that? Because what they really need to see is the data support a higher R-star. So we'll find out in maybe 3 to 4 years where R-star is today. It's really hard to know where it is right now as it stands.
And Lara, this sort of goes to this framework of it's hard to know where the end zone is going to be, also just in inflation. As John was mentioning, you think inflation is going to remain stuck at around 3%. What would you have to see to rethink that? We have Neil Dutta coming out this morning with a note after this data came out, just saying, Every month this year has seen month-over-month core inflation lower than the same month in 2023. What happens if this pattern holds into the summer? Is that something that could make you rethink this idea of 3% as sort of the sticky spot for inflation?
I think, to me, the problem is that we really we don't remember how much everything had to go perfectly to get inflation at 2%. You know, today we've got commodity prices really moving higher. I think rents are going to reaccelerate. Ironically, high Fed, really restrictive Fed policy has stopped home construction, which is what's needed to help, unravel this whole real estate sort of stagnation and stuck at higher prices environment that we're in. Long story short, when you put it all together, we may well see inflation dip a little bit lower, but I think my forecast is a longer run problem of stubborn inflation above 2%, kind of the mirror image of where we were for the 5 years before COVID, stuck below 2%.
I always feel like Neil's regulating us, don't you? They always feel personal, those emails.
Totally.
Sent them out to clients,
Totally.
just saying.
Yeah.
I feel like they're sent to us directly.
It feels like he watches us and then screams to the screen when I speak. Like, you have no idea what you're talking about, Bramo.
Just saying, which is basically what he's done on this program before.
That's why.
Although you're both friends, apparently. I kind of believe that. Let's look ahead to next week. ECB next Thursday. Then we get the payrolls report. In our survey right now, keep giving you a sneak peek. Here's the latest. 180,000 is the median estimate in our survey. Previous number, 175. Subadra, can we talk about next week, both the ECB and a payrolls report? And let's start with payrolls, and we'll finish on the European Central Bank in a couple of minutes. What are you looking for from that report next Friday?
So our economists actually have a slightly higher forecast, if you will, for payrolls than the consensus. So I wouldn't be surprised if you get a 200,000-ish number. The unemployment rate is going to stay below 4% for perhaps the remainder of the year. So very strong employment report is again what we're expecting for next week. But if there's any misses, that's when the market's going to react. The market's going to shrug off an upside surprise, I think.
Lara, do you agree?
Yeah, I agree. The market seems to have happy ears right now. They want the rate cuts. That's the news that they react to more than, anything that would sort of push those back. At the end of the day, when we look ahead to rate cuts and when that could happen, we're starting to push up against the election calendar. I think we're just going to kind of give up the ghost slowly on a rate cut before the election and really focus on those December, maybe November meeting.
I'm not sure down investors have happy ears, but I get your point. Lara Rhame of FS Investments. Lara, thank you for that. Subadra, I just wanted to give you the final word on the ECB. Big conversation around this table about central bank divergence. The limits of that divergence, how far can this ECB go without the Federal Reserve?
So I think our European economists said it best, which is it's data independence. I mean, the Fed and the ECB is already committed to cutting rates in June, and they're going to do it, even though the inflation data that we got recently doesn't really justify them to cut rates in June. The question really becomes what comes after that. And to me, what really dictates the price action in the bond market is this divergence between the ECB and the Fed. I think that's going to keep rates between the U.S. and Europe diverging as well, because the Fed's going to stay on hold for the remainder of the year, and the ECB is going to still be biased towards cutting rates.
We came into this week saying it was going to kind of be a sleepy week. You could make your argument about whether it was or wasn't, but next week is going to be actually massive when it comes to both the JOLTS data, the payrolls. We've got, of course, the ECB
You're excited about
Thursday.
Next week?
I am excited. Yeah, I'm excited.
Okay.
So I just want to know what you're most excited about of all of these potential data points. The ISM data, we get manufacturing and services.
So I'd start with JOLTS. I mean, if you look at the job openings, we really want to see that head towards that pre-pandemic level relative to the number of unemployed. So that's a very important first metric on jobs. Beyond that, I'd be looking to hear from the ECB and what they're thinking about policy, not just for June, but beyond for the remainder of the year. And then payrolls. Payrolls is very, very important. And whether we keep that momentum that we've had throughout this year is going to inform us on whether the Fed is going to look at perhaps cutting rates in July or September, which
Yeah.
is not our base case, but that's something that we'd be looking towards. The Fed really wants to see the job market cool off as inflation is coming down as a justification to cut rates, and they want to see that data soften.
We are hitting the ground running in the month of June. We will have an engaged Lisa, I promise you, Monday morning.
Are you saying I wasn't?
Subadra, thank you. Just not on the politics, not this morning.
I mean, I'm not.
We know how you feel
disengaged.
about it all. I know how you feel
Well,
about it.
I don't think I'm alone.
You're not.
Okay, good.
I think there's a good chunk of the country that feels the same way. We talked about the double haters.
Yeah.
I think it's a very real thing in this country right now.
Okay.
Looking ahead to economic data,
Yeah.
jolts, job openings, good stuff. Equity futures on the S&P positive by a third of 1%. Let's get you some news elsewhere with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John, a quick check on Gap for you. Surging in the pre-market nearly 25%. The retailer reported first quarter results that topped estimates and raised its outlook for the full year. All of Gap's brands posted comparable sales gains and outperformed expectations. The company added Zach Poston as its creative director back in February and has turned to celebrities to boost visibility. Anne Hathaway and Divine Joy Randolph sported Gap dresses at recent fashion events. Paramount Global shares also rising in the pre-market, only 0.5% though. That follows a report that Skydance Media submitted a sweetened offer for a merger with the company. Paramount's independent committee is set to review that offer shortly, that according to the Wall Street Journal. In recent months, Sony, Apollo, Warner Brothers Discovery, and media executive Byron Allen have all expressed interest in Paramount. Apple is planning to overhaul its Siri virtual assistant using more advanced AI. Bloomberg reports the move will allow users to control the functions within app functions with their voice. The upgrade is one piece of Apple's larger AI strategy, which is set to be unveiled at the company's Worldwide Developers Conference on June 10th. And that is your Bloomberg Brief. John.
Danny, thank you. Thanks for this morning. Have a great weekend. Up next on the program, setting you up for the day ahead. You're watching Bloomberg Surveillance. Equities near session highs, up a third of 1% on the S&P 500, counting you down to the opening bell. Here's the trading diary for the week ahead. Monday, US manufacturing PMI. Tuesday, jolts and durable goods. Wednesday, ADP jobs data. Thursday, an ECB rate decision plus another round of jobless claims. And on Friday, the payrolls report. And you'll notice on this screen, no Fed speak, quiet period. Going into the Fed decision 2 Wednesdays away. Before we get to June, we need to wrap up May. Let's start with the stock market. Some of the standout themes: the AI wins and misses. 1, 2, the 90s renaissance that we're seeing in retail. Abercrombie & Fitch, Gap this morning, absolutely surging. We could talk about the airlines too. A lot going on in this equity market in May.
To me, the big takeaway is there's a shift of momentum. We're not necessarily seeing the melt up in the same kind of way, and there's more discretion. The meats are actually punished pretty significantly if there are certain areas that have been bid up in a significant way. And there's sort of a reality check, and how much is this being driven by yields at this level become more punitive as growth slows? And that, I think, is really probably the big takeaway.
Would you have guessed that Dow would be an AI miss this month and that things like utilities would be AI wins, the standout of the equity market so far this month?
I mean, if I said yes, you would laugh
Kinda
the whole way
shocking,
out
right?
of here. It's
Kinda
completely
shocking.
shocking because people don't have a handle on how quickly this can be rolled out, how feasible it is to get all of the elements like copper to really build out some of the utilities and the infrastructure. But there is this sense there is a sea change underway. How do you bet on that is really now the big question.
The big word this year, and there's been many, but bifurcation, I think, is one with the consumer. And bifurcation that we're seeing now within industries too. The winners in retail, the losers in retail. Coles, a loser. The winners, we've talked about those already. In the airline business as well, American, a loser. Everyone else, Delta, United, doing better. That's been a theme through May and potentially going into June and beyond.
And there are two aspects to this theme. One, who can cater to the high-end customer better, right? Who can keep that customer base? And two, who wins? Because there's a shrinking pool of cash, at least on the lower end. So who's going to win on that? Is it going to be the Walmarts? Is it going to be the Costcos? Is it going to be the Dollar Generals, which actually came out with better than expected results?
How is the consumer doing? Big payrolls report next Friday. Looking ahead to that, lots of economic data going into June. Also, we're really kicking off the election season now for November with that first debate at the end of next month.
End of next month, the first debate, and then comes the sentencing for Trump's verdict yesterday. And that's going to be on July 11th. And then just around the corner, a few days later, the RNC, where he's going to officially become the Republican nominee for president. And, you know, it really kicks off today, I think, at 11 a.m. Trump will be giving a press conference, and his message is likely going to be similar to what it was last night. This has to now do, the verdict really comes down to November 5th with the American people.
And how the president navigates this issue over the next couple of days, the next few weeks, going into that big debate.
It's going to be fascinating. We're all going to be tracking every single move of it.
I don't buy that from you at all.
The problem is it's not going to change anything. That's what everybody's been saying.
You're not alone. You've got company. They're frustrated too. Coming up on Monday, United Airlines CEO Scott Kirby, Michael Kushner of Morgan Stanley, Cameron Dawson of New Edge Wealth, and Marriott International President, CEO Tony Capuano. AMH taking a little break. Enjoy.
Thanks. Looking
Anytime.
forward to it.
From New York, this was Bloomberg Surveillance.
Welcome back to another special Roland Garros update for Bloomberg TV and radio. From Tennis Channel, I'm Andrew Guy. World number one Novak Djokovic dialed in his game as he swept past Roberto Carballes Baena in straight sets to reach the third round. The three-time champion thrilled the crowd as he dominated the Spaniard from the very first ball. And don't forget, you can watch all the action live on Tennis Channel. Our daily coverage starts at 5 a.m. Eastern.